House Financial Services Committee will bring you that Q&A when it starts later this hour. It's also Fed Day, so there'll be complete Fed coverage this afternoon. Here at Bloomberg Intelligence, we're going to check in with Geetha Ranganathan. Disney reported some pretty good numbers, and they're opening a new theme park over in the Middle East in several years. So big momentum behind that stock. The streaming business doing better. Danielle DiMartino Booth, she is the CEO and Chief Strategist for QI Research. She is in our studio. We always like to have Danielle in our studio on Fed Day, get her thoughts on where this Federal Reserve is going to do. So busy day, we'll bring it all to you. And we're going to kick it off with John Tucker with a Bloomberg Business Flash.
All right, thanks, guys. And this market drivers report being brought to you by IBKR with a year-over-year change in the U.S. CPI. You see 2.6% at April 2025. At IBKR forecast trader, the yes was recently at 26%. Start predicting today at ibkr.com/forecast. Last trading day for this contract is May 12th. Ahead of today's Fed decision, major stock averages for now are higher, and the parade of earnings continues. Best performing stock in the Dow Jones Industrial Average. You want to guess? Disney.
Mickey Mouse.
Yes, they forecast adjusted earnings per share for the full year that beat the average analyst estimate. Julian Emanuel of Evercore ISI, meantime, says it does remain a really tough environment for investors.
We do believe that you are going to, and it's obviously a difficult path, avert the recession, barely. But again, when we think about where the market is right now, there's that high level of uncertainty.
Right now, the S&P 500 up 26 points. That's up 0.5%, 56.33 on the index. The Dow Jones Industrial Average up 249 points. The NASDAQ 100, 65 points higher. Steve Madden, ticker symbol SHOO, SHOO, the latest company to pull its sales and profit outlook for the year amid the trade war. The shoe retailer forecasting almost 20% growth just a few months ago. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, JT. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. Market Movers is brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. All right, let's take a look at some of the stocks on the move today. I'm Alex Steele with Paul Sweeney, and we are joined by Bloomberg's Carmen Reinecke. Let's start with Weight Watchers. So interesting on a day where you have Novo stock up, and then you have Weight Watchers having to file again for bankruptcy.
Yeah, for sure. So Weight Watchers, its ticker WW, also rebranded as WW International. Shares are down about 42% right now. The company said that it will file for bankruptcy after failing to compete with GLP-1 drugs like Ozempic. This is interesting because Weight Watchers actually even tried to offer some of these drugs on its platform a few years ago. It really tried to sort of get behind this wave of weight loss, but it didn't work. So it's filed for Chapter 11. It's looking to restructure and cut about $1.2 billion in debt from its balance sheet. The proposal still needs to be approved by a bankruptcy judge. And this, 42% seems like a lot for this stock. It's fallen so much. It was over $100 a share, I think, in 2018 or 2019, and now it trades for, pennies on the dollar.
Wasn't Oprah Winfrey involved in this at one point?
Yes, she was. She was one of their spokespeople.
But I'm going to guess she sold her stock already.
TBD. We don't know. Okay. We can check it on the Bloomberg terminal at HTS.
Sure.
All right, let's go to Charles River. What is this company?
Yeah, so I actually was not familiar with Charles River Labs, ticker CRL, either, but it's a company that provides research, tools, and support services for drug discovery and development. So important, in getting new drugs to the market. Shares are up about 20% right now after it raised its profit forecast for the full year and reported better than expected first quarter results. The company also said that it's in a cooperation pact with Elliott Investment Management, sort of the famed activist investor, which is also its largest investor. So we'll be working with them going forward. And Elliott has a great track record of boosting the stocks of companies that it's working with, both sort of on the day that the news is announced and even a year after.
Cool. All right. Mickey Mouse, what's going on?
Yeah, Disney is the top performer on the Dow today. Shares are up 9%. So the company reported results that were better than expected, and also gave a boosted full year guidance at a time when we've heard so many companies either cutting or just pulling them due to tariffs. One of the things that was doing well is the streaming business added subscribers even after they boost prices, so showing some strength there. They also announced that they are going to open this theme park in Abu Dhabi, which is a major tourism hub. And actually, there is a Ferrari World, a Warner Brothers World, and a SeaWorld World park there.
Really?
So interesting.
Ferrari Park.
Yeah, Matt Miller.
Yeah, that piqued a lot of people's interest in this room.
So another thing that's interesting about Disney, so they said that they are going to be announcing more about this ESPN flagship next week, and that it also will not be called ESPN flagship.
Good. Can't wait to see. Plus is going to be in there somewhere. So, Carmen Reinke, thank you so much. We appreciate it. Carmen Reinke, equities reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Let's stay on that Disney story again. The stock's up 9%, although it is down 9% for the year. So they got some work to do there. We're going to go to the analytical side of this story. Geetha Ranganathan, she is the media analyst for Bloomberg Intelligence based down in Princeton. Geetha, you followed this company for many years. Have they finally turned the corner, and can they become a stock that most people need to own?
I think so, Paul. I think, this turnaround story has now been in the works ever since Bob Iger came back more than 2 years ago. And it looks like, everything that he's kind of put in place along with the CFO, Hugh Johnston, is really working. So they did raise guidance, for the full year. But it's not just that. It's just the conviction in the outlook as you kind of look out and build out the earnings model for the next few years. I mean, we are basically looking at them doubling their EPS from close to almost $6 this year to well over $10, $11 in the next 4 to 5 years. So just a lot of conviction, I think, now in their long-term growth trajectory with those new parks, with the added capacity, with the $60 billion investment, with, the Abu Dhabi park, new cruise ships. Everything seems to be finally kind of coming together.
Last quarter, though, the question was about their theme parks. Prices are too high, the consumer's pinched. There was a competitor opening up a park in Florida, and everyone was kind of worried. What changed in 3 months?
Yeah, so they did say at that point that, summer bookings were strong. Of course, nobody really believed them. But, when they kind of reported the numbers today and you saw that 13% increase in operating income in the domestic parks are really the bread and butter of, the Disney theme park business, makes up 70% of revenue. Then that has really managed to, I think, allay fears. And they, it's not just what they reported, Alex, it's what they said for the remainder of the year. So they said bookings are up this quarter 4%. They said advanced bookings are up for the fiscal fourth quarter 7%. And that is with that new Epic universe coming on board. So still demand seems to be really resilient. It seems to be strong. Even though there's a little bit of softness internationally, domestically, they seem to be in very good shape.
So, Geetha, talk to us about the profitability of their streaming businesses writ large here. How profitable are they? Do you think they can approach the profitability of, say, Netflix?
I think they can. Over time, they definitely can. So this year, Paul, we're looking at just over $1 billion in operating income on a $25 billion in revenue. That's about 4-5% margins. But really what we're looking to, the North Star here is definitely Netflix, as you just pointed out. Netflix should get to 30% operating margins this year. So that's really what Disney is working towards. So even as we kind of build out, or we look at the earnings trajectory for that streaming unit over the next couple of years, I mean, we look at them getting to, 15-16% margins over the next 2 to 3 years. And then, of course, a lot more upside with, the pricing power, with subscription growth, with password sharing, with their advertising build out. So they have a lot of different levers that they can pull as well.
Is the goal to catch up with Netflix in terms of streamer subscribers? Is it about profitability? Like, what's the goal there? Because Netflix is so far ahead just in basic numbers.
Netflix is absolutely far ahead. There's no doubt about that, Alex. They have well over 300 million subscribers just in terms of scale. Disney has about 125. So there's 125 million. So there's a lot of catching up to do. But there is one area where Disney is far ahead of Netflix, and that's advertising. They have a very, very good advertising infrastructure. And this is an area that Netflix is kind of really struggling with. And then remember, Disney has a big weapon that they can use with that ESPN. It's not going to be called flagship, I know, but with that ESPN streaming launch coming a little bit later this year, they have, they're spending something like 11 to 12 billion dollars in sports rights that they are going to monetize from a streaming perspective. So that is where, they're going to have an unrivaled streaming product, even when you compare it to Netflix, because they're going to offer you entertainment, they're going to offer you sports, there's going to be something for everybody. So it's going to be, I think they can, I'm not sure if they're going to completely be able to match Netflix in terms of subscriptions, but they're going to be able to get to that profit number, I think, pretty quickly.
Keith, if I'm an investor in Disney, do I just kind of write off what used to be the core business, which was the cable network business, and just say, it's in secular decline. I'm focusing more on the growing streaming business. Is that kind of the play?
That is the play, Paul, and that's across majority of the space. So, yes, it's just kind of, humming along, if you will. Advertising is a big concern there. Affiliate fees, again, is in secular decline. We know other companies are actually trying to separate out their cable networks business just because it's been struggling and the outlook doesn't look good. Comcast actually is separating out its cable networks a little bit later this year. They even have a new name for that new business. And, we kind of expect WBD, Warner Brothers Discovery, will do something similar. But yeah, I think it's pretty much, at this point, it's pretty much written off, Paul. The linear networks business is dying.
All right, Geetha, thanks a lot. Really appreciate Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media on Disney earnings. Just for an update here, Treasury Secretary Scott Bessent is currently testifying for the House Financial Services Committee. We will bring that to you live when the Q&A portion starts. Bessent is currently reading his opening statement. All right, well, yesterday, he kicked off meetings on Capitol Hill, starting with the House Appropriations Committee. While answering questions in front of the House Appropriations Committee yesterday, he did warn that his department is on the warning track towards exhausting its capacity to stay within the federal debt limit.
We will share with Congress when we believe we are approximating that date. So that will be forthcoming. But I will tell you, just as an outfielder running for a fly ball, we are on the warning track. And when you're on the warning track, it means the wall's not far away.
Clearly, I don't know what a warning track is. But now, for those of you, I hope you do know.
We had that conversation off air during that.
We did?
With visuals.
Oh, we did, right
Yes,
now, yes.
yes.
And then John Tucker was pretending he was in the outfield. It was a whole thing. So now we got that. All right, well, joining us now in studio to discuss and also look ahead to Fed Chair Jay Powell later on today is Danielle DiMartino Booth, CEO and Chief Strategist of QI Research. Lots to get through. Just to start on what we're going to see in Capitol Hill, any key things that you're looking at? Maybe if there's something other than a sports reference?
Well, I think that there's likely to be more discussion of the X date. In fact, I think that one of the reasons that that Powell was seen, at least by his chief lieutenant Christopher Waller, as being more preemptive in reducing quantitative tightening was because of the unknown of how quickly this X date is going to creep up on us. So at least the Fed is in a position to not be pulling too much liquidity out of the system as we approach this kind of due date, if you will, for the financing of the country. So I think he'll be pressed on that further, as well as on the nature of tariffs. And yesterday there was quite the back and forth, and a contentious one at that, between one of the members of Congress and Bessent about isn't a tariff a tax to the consumer. And Bessent kept pushing back and saying, it depends. We will find out.
So if you're Fed Chair Jay Powell, can you wait and see how it plays out? Or do you have to get a little preemptive? Because I'm not sure if you're a hard data or soft data kind of person, because they're kind of telling two different stories a little bit.
Well, actually, Torsten Slott put out a great chart a few days ago that shows that there's a record disparity between what the soft data and the hard data are showing if you're looking through the prism of the unemployment rate and U.S. households' expectations for rising unemployment in the next year. We've never seen this kind of a disconnect. And we unusually have 6 Fed speakers out of the gate on Friday. I mean, it is a deluge of individuals. And most of them, right before blackout, were starting to say, we're going to have to pay closer attention to the risk for rising layoffs. We need to pay attention to some of these sentiment surveys. All Americans can't just have something in their mind. They have to be seeing something on the ground. And in fact, if you look at the beginning of the month of May, you were just talking about Weight Watchers a few minutes ago, for the entire month of April, BCY Go on the terminal had 7 large bankruptcies. So far this month, we've had 6, plus one massive strategic default. Office Properties Income Trust, S&P downgraded them to strategic default as tantamount to default yesterday, 2.14 billion in liabilities. But we've effectively seen 7 in early May, whereas we saw 7 for the entire month of April. There's fallout when we start to see these bankruptcy flows, and household bankruptcies in the month of April were up 16% year over year. That's according to U.S. bankruptcy courts. That's hard data.
Yep.
So you've been concerned for a while.
Mm-hmm.
How much more concerned are you now than maybe you were 3 months ago? And what is an appropriate policy response?
So whether you're looking at Macro Edge or the long-term provider of layoff announcements, Challenger Grain Christmas, after the Department of Government Efficiency layoffs kind of worked their way through the data February and March, all of a sudden, boom, we still had 100,000 layoffs in the private sector announced in the month of April. I think that this is relevant. I think we are going to see a pop. Anna Wong agrees with me that the damage that's been done in transportation, logistics, warehousing, that we're going to see that show up before the Fed meets again on June 18th. Just, to say nothing of higher layoffs coming from other channels.
All right, Danielle, we're going to go down to Washington, D.C. Thank you very much for
you.
coming us to an important day here today, the Fed Day. Danielle DiMartino Booth, CEO and Chief Strategist, QI Research. We always love chatting with her on Fed Day. Let's go down to Washington, D.C. The Q&A is beginning of Treasury Secretary Bessent as he testifies before the House Financial Services Committee. Chairman French Hill is asking questions at this point. Let's go down to Washington.
The World Bank should make that a key
Mr.
effort.
Bessent is speaking at the moment.
Thank you. Also referenced my work over the past 5 years with the Treasury and others about IMF reforms. You also referenced that in your talk. Recently, the IMF shareholders agreed to a quota increase, and I appreciate the agreement that this agreement does nothing to increase the voting power of China or Russia, but were Congress to approve this agreement, it would allow future administrations to greenlight more general special drawing rights allocations close to $1 trillion. And that would mean $60 billion of new unconditional liquidity for the Chinese Communist Party, $25 billion for Moscow, and $7 billion each for the regimes in Caracas and Iran, with no sign-off from Congress. So even if rogue regime FDRs are rejected by Western countries, which we've seen in the case of sanctioned countries, they still could be exchanged behind the scenes for Chinese RMB, for example. And I believe this is unacceptable. Would Treasury, under your leadership, work with me to reform the SDR allocation process at the IMF?
Mr. Chairman, we believe the SDR process at the IMF should serve the goals of the United States of America and not other states. And as I said in my speech during IMF week, this administration is aligned with you in your goals on the SDR. And furthermore, we believe that the IMF needs to get back to basics in working with countries when there is a market failure in financial markets rather than helping large, well-financed countries.
Thank you. Well, we look forward to following up with you and walking through this. It won't be an easy task, but with international leadership from the United States, I think we can get there, and I think we will all benefit. And that means countries in trouble will benefit instead of just the general allocation approach. The president, since he's been in office, has championed high-profile investment issues revolving China. As everyone knows, he's been negotiating U.S. investors' acquisition of control, for example, over TikTok. In his State of the Union address, President Trump announced a major investment would see Americans take control of 2 ports near the Panama Canal that are currently owned by a Hong Kong-based business. I'm concerned that recently established outbound investment restrictions could make deals like this even more challenging. Under the regulations, U.S. investors don't actually know which companies are off limits, and Americans face bureaucratic hurdles if they want to take control from Chinese owners. What are your views on revising outbound program to change this? Since the president wants strategically to see American investors take control perhaps of some Chinese-owned entities, how do we make sure we get outbound rules right?
Mr. Chairman, I want to thank you and the members of this committee for leadership on this. I had a very good discussion with two members yesterday where we talked about the importance of establishing a either red light or green light and not having a yellow zone for outbound investment. The outbound investment security program is an important national security tool in our effort to restrict the PRC from exploiting the benefits of U.S. investment. We've been receiving notifications from the outbound program. We're monitoring the market, and we're trying to ensure that the investment community is aware and familiar with the program. We appreciate the interest from Congress, and while legislation will be important and helpful, we would like a bit more time to process, including the work mandated by the president to inform legislation.
I appreciate that. We look forward to working with you. I yield back, and I'll turn to the distinguished ranking member of the committee, Ms. Waters, for 5 minutes.
Thank you very much, Mr.
You're
Chairman.
listening to
Secretary
Maxine Waters. The House
This
Financial
is the
Services
first time
Committee is
we've
now
met.
questioning
Is
Treasury
that
Secretary Scott Bessent.
No, ma'am, we actually met one New Year's Eve in the Bahamas. And I was...
He didn't make an impression.
Why
don't I remember that?
Well, you were much better at the electric slide than I was. And I was with the Prime Minister of the Bahamas yesterday, Prime Minister Davis, who sends his regards.
Well, were you with my husband when he was the ambassador to the Bahamas appointed by Clinton?
So.
Well, you're not gonna like this. And so this is the first, I didn't remember that, but that's odd because you've been at Treasury and I've sent you 5 letters to ask about what was going on under your leadership and only received a couple of cursory replies from your staff. Why didn't you respond?
Ma'am?
I guess you don't know why you didn't respond. Secretary Bessent, you worked in finance before, right? You will find bipartisan support on this committee for small businesses and the institutions that finance them. I worked with Trump's first Treasury Secretary to pass $12 billion in support for community development, financial institutions, and minority banks and credit unions. So I was surprised when Trump first tried to eliminate the CDFIs, but it caught you by surprise also. You said that the CDFI fund plays an important role in expanding financial access. Unfortunately, you were not very persuasive last week. Trump proposed to basically cut all CDFI funding. Now, let's discuss your job before becoming secretary. Your hedge fund had a secret sauce for how you would make money for investors, a proprietary trading strategy. As CEO, you guarded that strategy. You never allowed unrelated persons to access your firm's computer records, data, personnel files, and algorithms, right? And I'm sure you wouldn't have allowed just anyone unfettered access to copy, change, or to use those records, right? I suspect not. And that makes good sense. What doesn't make good sense is why, as Treasury Secretary and acting CFPB Director, you would allow those unfettered access to the government system that handles trillions of dollars in payments to the proprietary business records of entities regulated by the CFPB, or most alarmingly, to the tax records of hundreds of millions of Americans. But you still threw up the gates of our finance system open to Elon Musk and his band of 22-year-olds. Yes or no? Do you know the level, type, or nature of the clearances and security training required for individuals to access the information held in the computers of Treasury, IRS, or CFPB?
Yes, I do, and I think we would have a disagreement over the definition of the word unfettered.
Mr. Secretary, did all the individuals working with Doge who were given access to Treasuries and CFPB's computer databases receive all of the required clearances and security training before they were granted access?
Again, they were granted read-only access at Treasury. There were two.
So let me just say,
Doge employees.
please, you can't filibuster here. This is not the filibuster playground. And so what you did was you let these strangers into our Treasury with access to all of the data, all of the personnel information, and you just opened the door. Why'd you do that?
No, ma'am. They were Treasury employees.
Oh, are you saying today in front of this committee that all of them were Treasury employees, that the 25-year-old who's being identified, who worked for Elon Musk, was allowed into the Treasury? Was that person there?
He was a Treasury employee, as was Tom Kraus, the senior person on the Doge team. There were only two people.
There were Doge employees also.
Sorry?
Do you know, were you aware that there were Doge employees coming into our Treasury, getting all of our personal information?
Well, ma'am, there is no such thing as a Doge employee. There were Treasury employees.
I tend to disagree with you based on the information I had. Has any information been downloaded by anyone working with Doge from any of Treasury's or CFPB's computers? Answer yes or no.
Not to my knowledge.
You better learn.
Gentlewoman yields back. The gentleman from Michigan, the vice chairman of our committee, Mr. Heisman, recognized for 5 minutes.
Thank you, Mr. Secretary, for being here. And I just have to note that it's ironic that this has been
Senator
declared
Bill
a no filibuster
Huizenga
zone by
from
the
Michigan.
same people who walked out of a hearing yesterday in filibuster. So, and just to give you one quick
Congressman
brief
Huizenga,
moment, are you saying that there was no unauthorized or unsanctioned persons that had access to the systems that you are in control of?
Again, there were two employees.
Yep.
There were very strict guardrails, and they were there for an ERP function.
Yeah, so they were authorized and they were sanctioned.
Yes.
So not unknown, and Elon Musk wasn't one of those two people?
No, to my knowledge,
Okay.
Mr. Musk has never been in the Treasury building.
Okay, all right. I have to hit on Burma and a little crypto, and if we have time, China. So I want to thank you for your actions that Treasury took this past Monday regarding Burma. The KNA, the Karen National Army, has become a haven for transnational criminal organizations that run illicit operations such as human trafficking and smuggling. The group has strong ties to the Burmese army, which has targeted religious and ethnic minorities such as the Rohingya since the civil war broke out in 2021. While the U.S. and our allies continue to impose sanctions against the military junta, unfortunately, the atrocities continue. My district, the 4th District of Michigan, is home to approximately 5,000 of these ethnic Burmese. And I'm just asking you, we need to do more to protect the people of Burma and to stop the genocide. Yesterday, I reintroduced the Brave Burma Act, a bipartisan piece of legislation that would require the president to determine on an annual basis whether to impose stronger blocking sanctions against the Myanmar oil and gas enterprise, the Myanmar Economic Bank, and foreign persons operating in the jet fuel sector of the Burmese economy, which has been a tremendous amount of their revenue. And it further limits the junta's ability to borrow at the IMF, which I think is one of the issues that the chairman was touching on. So these actions would target the heart of the military junta's revenue. So can I get your commitment that you're going to continue to work with my staff and us on a bipartisan basis as we try to address these issues in Burma?
Congressman, we're happy to work with your staff on this legislation, and thank you for your leadership on this issue. I share your concern about imposing consequences on persons who threaten the peace, security, and stability of Burma. Treasury has tools to continue to take action for the people of Burma, and working with you, we will continue to do so.
That's great. And what's frustrating is while some of these sanctions have been put in place, a sanction's only as good as the willingness to enforce it. And we have seen them receiving financial support, the junta, from around the world, especially, frankly, as they ramped up production during the last administration. So I'll note it's not just Burma, it's places like Iran, that this illicit activity that has gone around the sanctions has been allowed. In some cases, Treasury has granted these licenses. I sit on the Foreign Affairs Committee as well, and we see this all the time. I want to touch on crypto. Yesterday, as I had mentioned, the committee held a hearing with House Agriculture, or attempted to hold a hearing with the House Agriculture Committee. Turned into a very important roundtable as well regarding digital asset market structure reform. So can you quickly explain how important it is for America to take the lead here, especially as we see China leaping ahead?
Yes, sir. We believe that the United States should be the premier destination for digital assets. And as members of this committee and the Senate are attempting to do, create good market structure around that, so that U.S. best practices are used around the world.
And that's really the point, right? Is having American U.S. best practices to sort of set the pace for others to follow, rather than us trying to fill in the holes that others that may be created as others set that pace.
Yes, sir. And also, the digital assets are an important source of innovation that will drive that can drive usage of the U.S. dollar around the world, as with stablecoin legislation. There is speculation that there may be up to $2 trillion of demand over the next few years for U.S. government securities from digital assets.
My time has expired, but I'll send you my question regarding Chinese debt trap diplomacy. So with that, I yield back.
Gentleman yields back. Gentleman from New York, ranking member of the Small Business Committee, Mr. Velasquez, is recognized for 5 minutes.
Mr. Chairman, I want
You
to
are
raise
listening currently to
order.
Congresswoman Nadia Velasquez from New York, questioning
I don't
Treasury
want-
Secretary Scott Bessent in the House Financial Services Committee.
I would like for the witness to be sworn in before I ask my questions.
Chair doesn't see a need for that. You may ask your question. Your time can start the gentlewoman's time over 5 minutes.
Secretary Bessent, you were on CNBC earlier this week making claims saying we are very close and maybe we will see some deals this week on tariffs. So tell us, tell the American people, tell small businesses and consumers, tell retirees, specifically, which countries are you close to striking deals with?
I'm sorry, Congresswoman, but that would not benefit the United States.
No, I'm asking you a question based on the statement that you made on CNBC.
And I am telling you that it would be detrimental to the interest of the United States for me to answer that question.
Why will that be detrimental?
Because as the negotiations may still be in process as we speak, as we are not at the end of the week yet, I am sure that you through your question, would not want to compromise U.S. negotiations.
Reclaiming my time, Secretary Bessent, the president goes into a press conference and claims that there are negotiations going on. And then the next day, there's no negotiations going on. So why would you not answer my question? And that will be considered detrimental to the American people, to the American economy. I do not understand. Despite your claim,
I'm happy to say there are negotiations going on. I'm not going to reveal the details.
So how long do you think those negotiations will take before they are concluded?
There are numerous countries, as I have said, if you saw my CNBC interview, which you referenced, that there are 18 important trading partners, and we are moving forward at all deliberate speed with those.
Do you consider these negotiations advanced negotiations?
Some of them are quite advanced.
So you expect this deal to be more than memorandums of understanding? You expect them to be full negotiated trade deals?
I believe that they will be the agreements in principle, and then we will paper them over in the coming months. But once we reach an agreement, then I am sure that the other countries will live up to it.
Okay. In congressional testimony yesterday, you said the U.S. has not started negotiating with China on tariff reductions. Does that continue to be your position, yes or no?
As you may have read,
yes or no, sir?
As you may have read in the press, I will be going to Switzerland, and the negotiations will begin on Saturday.
Okay, so the president told you that that will be your answer today. So can you tell who from the Trump administration is engaged in those discussions?
Which discussions?
With China.
Trade discussions?
Pardon?
I'm sorry.
Trade discussions, yes, sir.
Well, the trade negotiations will be led by myself and Ambassador Jameson Greer,
and
USTR.
And what about Pete Navarro?
Sorry?
Peter Navarro.
He will not be joining us in Geneva.
Thank God for that. Are those negotiations considered advanced?
Pardon?
Are those negotiations considered advanced?
As I said, on Saturday we will begin, which I believe is the opposite of advanced.
Secretary Besson, as Treasury Secretary and a senior member of President Trump's economic team, has President Trump given you the authority to finalize any trade agreement with China or any other trading partner?
As President Trump has stated, he will have the final decision on any trade agreement.
So you're telling me all of these increased prices, the stock market losses, the production delays are all based on the wins of Donald Trump, that you could strike the best deal with Canada, Mexico, or even China that is completely in our favor, giving us everything the administration
Gentlewoman's
is
time is
seeking.
expired.
And if President Trump decides at any certain moment,
Gentlewoman's time is
for whatever reason, not to take the deal, that will be it. I yield back.
The gentleman from Oklahoma, Mr. Lucas, who is chair of our Task Force on Monetary Policy, is recognized for 5 minutes.
Thank you, Mr. Chairman. Lucas, a representative from the state of Oklahoma, speaking to Treasury Secretary Scott Bessent in the House Financial Services Committee.
Can you give an updated assessment of those events, and how would you characterize the functioning of the market during that period? Bring the dust up in Treasury.
The
markets.
How the market was very well functioning. It was volatile, but the underlying infrastructure worked quite smoothly, sir.
Does the Treasury Department have the tools necessary to address market volatility? You've said you may increase the use of the buyback program. Are there other authorities that might be helpful to address the challenges of the market?
Yes, sir. We have a very large toolkit that we can deploy, as does the Federal Reserve.
Taking a step back, Mr. Secretary, can you provide us with a sense of what regulations the administration is working on to bolster resilience in the Treasury market and the timelines when you would expect those changes to be announced? This is a core issue on the task force I and a number of my colleagues are working on.
Sir, the auction sizes, the current issuance sizes leave us well positioned to address potential changes in borrowing needs. I can tell you that investor participation in auctions, there's been broad investor support. Our weighted average maturity is about 61.2 months, which is quite fulsome. And we have implemented a buyback program with two objectives: liquidity support and cash management.
One last question along that line. I've long said that the administration should look at reforming regulations like the supplemental leverage ratio to relieve some of the constraints that market participants are facing in the Treasury market. I hope you'll consider looking at that.
Sir, Treasury does not look at that, but I believe that it is a high priority for the three regulators, the OCC, the FDIC, and the Federal Reserve.
Thank you. And as the SEC continues to implement their clearing rule, a number of firms, including those outside the United States, are looking to provide clearing services for U.S. Treasuries and their derivatives. How are you working with the SEC and the CFTC to ensure the integrity of the Treasury markets as these firms look to intermediate?
Sir, the Treasury market is a global market, and we welcome new participants, and we want to make sure that best practices employed in the U.S. are also employed globally.
And the reason I ask that is, and if you could specifically comment on the clearing of U.S. sovereign debt outside of the United States, what risk could that potentially present? And I come at that from the perspective, if there's a challenge in the market, if it's a U.S.-based entity, then the regulators who would make the difficult decisions are here. If it's outside of the United States, they might have a different perspective.
We are constantly studying that, sir. As of now, we do not believe that it presents a risk, but I will, as we continue our studies, I will have my staff interact with your team.
Absolutely, Mr. Secretary. And one final question. Primary dealerships has become an expensive proposition for firms, which in one explanation for participants leaving the market, it's one of the many explanations. Should we be looking at ways to make the environment friendlier to investors wanting to become primary dealers?
Sir, we saw at the recent auction very low participation by the primary dealers, which tells me that there may be the regulatory function there that is preventing them from using their balance sheet for the benefit of the U.S. Treasury.
So clearly the task force that Chairman Hill was kind enough to set up and yourself, we have work to do. Thank you, Mr. Secretary. I would yield to the gentleman from Michigan.
Thank you, and I can get my China question in, so I appreciate my colleague doing that. I want to talk a little bit about the international financial institutions, the IFIs, such as IMF, World Bank, and they're falling short of
listening
addressing
to
key
Bill Nzinga
challenges.
of the House Financial
China,
Services
whether it's in
Committee,
Africa or Burma,
representative
is
from
really
Michigan.
engaged in a debt trap diplomacy. How should the IMF really help borrowers take the fund's advice when it keeps giving China a free pass?
Well, Congressman, as I said in a public interview after one of my IMF speeches, it is time for China to graduate from developing country status. It is the second largest economy in the world. They are a large, important economy, and they should no longer be granted the status of a developing economy.
I'd like to invite you, Mr. Secretary, to continue that answer in writing. And I thank the Vice Chairman and Mr. Lucas. Let me call on the gentleman from California, the ranking member for our Capital Markets Subcommittee, Mr. Sherman.
First, a parliamentary inquiry.
Brad
Since
Sherman,
the last speaker had an extra 30 seconds, can I have an extra 30 seconds?
Right.
I would be happy to do that.
Mr. Chairman, I agree with you that special drawing rights should be increased only with congressional input. And I agree with Mr. Huizinga that we have to focus on Burma, Myanmar. I ask unanimous consent to put on the record a chart showing how the value of the dollar compared to other currencies has declined precipitously since Trump's so-called liberation date, and to also put into the record a CBO report issued just an hour ago that shows that Republican proposals to change Medicaid would in one case take 1.5 million people would lose their Medicaid benefits, and in another proposal would cost 3.9 million Americans their Medicaid benefits.
Without objection.
Also ask unanimous consent to put in the record a letter I sent to the Secretary, responded to by his Assistant Secretary, dealing with direct file, which means you don't have to pay TurboTax because the IRS has the software. And the response that I got, an absurd response, was basically, well, as long as, we just want to make sure TurboTax makes a lot of money, so we're not going to do that. And I would point out that the IRS could send every American, for their voluntary use, a proposed first draft of the tax return, since you already have the W-2, you already have the 1099, and you don't have all the input errors that come from people doing their own returns. But that is something that your administration is stopping. I would ask you, Mr.
Without objection.
Yes. I ask you, Mr. Secretary, to provide for the record within 1 week your best estimate of when the U.S. will hit the debt ceiling and exhaust our borrowing capacity. Can I count on you to provide that for the record?
Sir, the so-called X date is a moving target.
I'd like your best shot.
As I stated yesterday, we are moving on to the warning track, and we don't want to be on the warning track. And
I would ask you to provide the Congress the best information you can, but I'm going to go on to another question. I represent one of the two areas devastated by the Los Angeles fires. I spoke directly and on camera to President Trump and asked him to exempt building materials from these tariffs. The National Association of Home Builders says that these tariffs will add $11,000 to the cost of these fire victims rebuilding their homes. Can you assure us that in a country where we have a devastating housing shortage in general, but we have thousands of people in Los Angeles have to rebuild their homes in particular, that these fire victims are not going to face this additional cost to rebuild their home?
I will look into that matter, and I would.
That is exactly what the president said in January.
I was in Los
so
Angeles
far
this weekend, and I toured the devastation.
Thank you. I hope you saw the devastation of the Palisades, and I hope you won't be imposing another $11,000 cost on every home builder. Now, as to capital markets, where I devote most of my time, all of us on the subcommittee agree that we're trying to get people to invest in American stocks and build the American economy. And in fact, our tax code has hundreds of billions of dollars of incentives to get people to invest in America. China also has incentives to get the Chinese people to invest in Chinese stocks. But there's a difference. China only provides those incentives to Chinese people if they invest in Chinese stocks. American billionaires like investing in China, making tens and hundreds of millions of dollars in profit. Can you think of a reason why the American tax code should provide enormous tax benefits like the capital gains allowance to American billionaires who invest in Chinese stocks? Why is that in our national interest?
Sir, it's not just available to billionaires. If you were to buy...
Right, so why do we want to encourage...
buy a Chinese ETF, a very...
Why would we be neutral on whether I buy an American ETF or a China ETF? Don't we prefer American capital to be invested in America, or are we just fine with encouraging Americans to invest abroad?
Well, sir, we don't want to close the capital account, and we do want investors to be able to maximize their judgment where they should invest.
Let me go on to one more thing.
I have said I wouldn't bet against the U.S., but...
please, next question.
People can.
Next question. Abu Dhabi and United Arab Emirates just announced that they were going to give $2 billion to a stable coin put forward by World Liberty Financial. This stable coin pays no interest. So you and I are both finance people, just want to check my math. Assuming a 4% rate of return, is this interest-free loan of $2 billion worth $80 million every year to World Liberty Financial and its Trump owners?
Sir, I haven't seen that. I don't know the expense ratio, and as far as I know, no stable coins pay interest.
So the New York Times is wrong. Please read the article. I yield back.
Gentleman yields back. The gentleman from Texas, Mr. Sessions, is recognized for 5 minutes.
Mr. Chairman, thank you very much.
We're
Secretary,
listening to
welcome. We're
Representative
delighted that you're here.
Sessions
Part
from
of the,
Texas in the
challenge
House
against
Financial
you
Services
this
Committee
morning,
questioning
and I'm sure
Treasury
some
Secretary
days,
Scott
is the
Bessent.
explanation of the tariff matter that President Trump has initiated and sticking by. I'd like to provide just my input on that if I could, that I think that President Trump sees the relationship with China by what it really is, and that is an unfair relationship, one in which needs to be not only looked at, but really something done about it. And I know that while we have PNTR, it should mean that we treat them the same way they treat us, but that is not happening. President Trump, as part of these changes, has changed the de minimis rule, and that de minimis rule was the amount of money that a package, when it comes into our country under this circumstance, whether it was looked at or not, whether a tariff was paid upon it. And I believe that there were Chinese companies taking advantage of that. Some 4 million packages a day were coming to the United States. And I say were coming because I do not believe that that rate is still occurring. As a result of that, what happened is it contributed to the fentanyl issue that we had because we did not look at these packages with the same viewpoint that others did. My point in bringing this up is that I believe that with the new numbers of 177,000 net new American jobs being created in the private sector, that there's an understanding by people who want to invest in America that this president is finally taking on the Chinese, who undermined not just intellectual property, but undermined with their government, the Chinese government, undercutting the price and manufacture of many products that were American made. Many of them, or some of them, might be power tools. And of course, we know Craftsman is an American made product. But it is not uncommon, was not uncommon for their tools to be on the internet at $400 or $500, and for a Chinese product to be brought in for $40 or $50. That undermined not just our intellectual property, but actually undermined the manufacturing that takes place in this country. And I'm delighted that you and the president are engaged in balancing that out. And I think that's what this 177,000 new American jobs net provided for us, because it's people who want to invest in the United States, knowing that finally we have a president that will protect that onslaught of Chinese goods, undercutting American, not just jobs and intellectual property, but the events that take place therein. And I think this president has done a great job, and I want to offer my support for that, because I think that part of what the president has done is set a new challenge and mark for Americans now to pick up that part that was before challenged by China. Mr. Secretary, Russia still earns over $700 million a day in fossil fuel revenue that helps its war against Ukraine. And I think that most of us here would like to see Russia held accountable. Can you talk to me about sanctions that are or are being considered against Russia energy firms as it relates to selling their products to China?
Yes, sir. And I will tell you that the Biden administration exercised with regards to Russia and Ukraine support a big dichotomy. On one hand, they were giving aid to government of Ukraine. On the other hand, their sanctions against the Russian Federation were very, very weak. The sanctions were just against some of the lower level oil companies. There was a price cap that has never worked. On his way out the door in a fit of bravery, the National Security Advisor, Jake Sullivan, raised the sanctions because the Biden administration had been worried about upsetting the oil price, pushing up oil prices during an election year. The Trump administration, through our energy abundance and signaling to the energy markets, crude oil is down about 20% thus far this year. And I read with great interest this morning that Russian Federation revenues were down 12% last month, which will put a dent in the Russian war machine, sir.
Mr. Secretary, I hope that you'll find today
Thank you, Mr.
valuable for us and yourself, and I hope you'll know that we will.
Gentleman from
Thank you very much, Mr. Chairman.
Gentleman from New York, Mr. Meeks is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Bassett.
We now listen to Gregory Meeks,
I'm just a
representative
plain,
from the
simple
state
man,
of New
the
York.
average everyday American is looking at this hearing today. So can you tell me first, does trade deficits constitute a national emergency?
The hollowing out of the U.S.
No, just yes or no. Yes or no? Yes or no?
It's a national emergency, sir.
It does. It does. You're telling me trade deficits equals a national or creates
Persistent and prolonged.
Okay.
Yes, sir.
And do you know also, sir, that for the last 4 decades, we've had trade deficits in the United States of America, and nobody said it was an emergency? Democratic and Republican presidents? You know what that says to me? That it's not an emergency because it hasn't been for 4 decades. It says to me that we should bring tariffs back to the United States Congress so that we can make that determination as the Constitution has said and not try to go around Congress. It's just unbelievable to me. Let me ask this question. Maybe I'm just missed it. Who was the president? And who has been the president since January 20th, 2025?
Donald J. Trump.
Okay. And who was the president in 2024?
One believes President Biden.
One believes? You one of those non-believers that the election, the American people didn't vote?
I am not.
You're not? You said one believes? Do you believe in the Constitution of the United States and it should be abided
I
by?
believe in the Constitution of the United States.
So you believe in it without any second thought. You don't have to think about it. You believe in it and you will abide by it. Is that correct?
I have and I do, sir.
Okay. But do you know that a president has said he may or may not? He don't know? Let me ask this question. I couldn't believe my ears. Sunday, during NBC's Meet the Press, President Trump credited himself for the strong economy in 2024 when Joe Biden was president. But then he blamed President Biden for a weak economy in 2025 when he was president. Now, I'm not so sure how the American people puts that together. In 2024, strong economy, he tried to take the credit. In 2025, when he's the president, he blames Joe Biden. That doesn't make sense to me. I don't think it makes sense to most Americans. And I hope, Mr. Secretary, you're a businessman. It doesn't make sense to you either. It can't possibly make sense to you. Let me ask this question. If a government, say, look, Argentina, I remember when I came here, and Argentina kept failing to pay its debt. Not once or twice or 3 times. And we were all upset about it, and we said that they needed a host, somebody needed to take over their government. You know, somebody should help the president of Argentina. If the United States or didn't pay his debt or something like that, we'd be very upset about that if we couldn't pay our debt. I mean, that's one of our focuses. Is that not correct?
Sir, the United States will always meet its debt obligations.
Always. Well, let me ask you this. Donald Trump The deal maker, and you didn't answer Ms. Velasquez's questions, no deals. You said 3 weeks ago that there would be deals. But Donald Trump, not once, not twice, not 3 times, not 4 times, not 5 times, but 6 times failed to pay his debts on his business and went bankrupt. And you're going to call that a good businessman?
Gentleman's time has expired. Gentleman's time has expired. The gentlewoman from Missouri, Ms. Wagner, the chair of our subcommittee on capital markets, is recognized for 5 minutes.
I thank you, Mr. Chairman.
You were listening to Representative Ann Wagner, a Republican from Missouri, questioning
And I thank
Treasury
you,
Secretary Scott
for your
on the House
testimony.
Financial
I,
Services
sir, am
Committee.
going to try to stick to the actual title of this hearing and why we're supposed to be here today, which is the state of the international financial system. So here we go. Mr. Secretary, under the Biden administration, Congress required Treasury to determine whether any Chinese financial institutions were engaged in oil purchases from Iran, no matter how small or how large the transaction. This determination would subject these Chinese entities to secondary sanctions, sir. And just last week, the president himself ordered such sanctions for any purchase of Iranian oil, which helps, obviously, the Ayatollah finance terrorism around the world. Mr. Secretary, can you describe how, well, I think we all know how Iran uses oil sales to fund its proxies, including Hamas, Hezbollah, the Houthis in Yemen, to the extent that there's any Yemen left. Treasury is now over half a year late with its statutory determination on Chinese buyers of Iranian oil. And I have 3 questions, sir, related to missing this deadline. The first is, why has it not been submitted to Congress? Had the previous administration done anything to prepare this determination? And third, when can Congress expect to receive it?
To all 3 of those, I will have my staff get back to you on that. And Representative Wagner, what I will tell you is that since I become Treasury Secretary, the Treasury has repeatedly sanctioned so-called Chinese teapot refiners who are very large buyers of Iranian oil. These are independent refiners away from the state-owned enterprises. We have begun that program over the past few weeks, and we will continue as needed.
Good. Well, and I know that you're in negotiations with, I'll say, that 18th country, which is China. We are thrilled to hear of your trip there, and I hope that this is something that you will discuss with them in terms of their purchasing of Iranian oil that does nothing but lift up a regime that is funding terrorism throughout our world, I'll say. What actions has Treasury taken to combat cooperation between Iran and China on illicit finance and money laundering?
Well, again, the secondary sanctions on these teapot refiners has been a very fulsome effort, and we will continue that. When President Trump left office, Iranian oil exports were between 100 and 300,000 barrels per day. Now they are 1.6 million barrels per day, which allows the regime to finance its terror proxies, not just in the Middle East, but all around the world.
Correct. Yes, and we've seen it, and we've lived it, and it has caused unbelievable death, devastation, and grief, and resources, and loss of life throughout our world. And I am proud that the president himself endorsed sanctions just last week for any purchase, not just from China, of Iranian oil. So I hope that we can get a report on what's been happening with China. Switching gears, in February, several members of this committee and the Senate, including myself and the chairman, and the Senate Banking Committee sent you a letter voicing concerns about the European Union's Corporate Sustainability Due Diligence Directive, or CSDDD. This directive, which was finalized by the EU last year, will require many American companies to evaluate their supply chains and end certain business activities not based on U.S. law, but due to UN principles. This directive not only hurts our economic competitiveness, but also undermines our jurisdictional sovereignty, sir. It would force both public and private companies to comply with regulations that have not been approved by Congress, while also exposing them to increased litigation and risk in the EU. I am running out of time, Mr. Chairman, but this is something I feel very strongly about. It is in the international realm here, and I have two questions regarding this.
Gentlewoman,
that I
time
will
has expired.
submit for the record. Thank you.
They will be submitted for the record. Recognize Mr. Scott, the gentleman from Georgia, for 5 minutes.
Thank you, Chairman.
Listening to Representative David Scott of the state of Georgia.
Let me ask you this.
Treasury Secretary Scott
Do
Besson
you
testifies
agree
before the House
that
Financial
the
Services
FDIC
Committee.
plays a very essential role in safeguarding our depositors, ensuring prudent bank supervisors, and maintaining the safety and soundness of our financial system?
Congressman, I agree that a well-functioning FDIC is essential to the U.S. financial system.
And on Monday, you said this, and I quote, you said this, that the president tasked you with helping him choose the leader of the financial regulators so that we are all aligned, all regulators, to be safe, sound, and smart. And you went on to list the key positions that you've done that, including a new vice chairman for supervision of the Fed, a new head of the OCC, and Paul Atkins of the Securities and Exchange Commission, and a new CFTC commission. But as of this morning, we have no FDIC chairman full time. It is now under temporary leadership of an acting chair named Travis Hill, with the president having no current plans to either formally nominate him or find a replacement. The nation is watching us. Why we don't have the head of the FDIC. So my question is, have you not helped President Trump in selecting a chairman to lead the FDIC?
Congressman, I would point out that under the previous administration, there was only an acting chair of the OCC for 5 years. 5 years. That Mr. Hill is the acting, and as a matter of fact, the head of the OCC, the head of the CFTC have not been confirmed, so those are in fact acting also. Mr. Hill is a very capable regulator, having been on the board of the FDIC.
Yeah, I'm not. And you're filibustering here.
We are pursuing
I'm not
decisions
questioning
with
that.
all deliberate speed.
Have you been instructed by President Trump to refrain from offering a list of viable candidates to lead the FDIC?
No, sir. I am constantly reviewing the list and thinking who is best to lead that important institution.
Well, I want you to know that I wrote a letter to the Trump administration, here it is, expressing grave concern with the erosion of financial regulatory agency independence. And, Mr. Chairman, I'd like to submit this for the record.
Without objection.
And we remain highly alarmed by this growing perception that our financial regulators have acquiesced to political pressure from this administration, perhaps even from the President of the United States. If I were president, I wouldn't have this vacancy at a time when we're running tariffs all over the country, when our economy is in these kinds of difficulties? The nation is watching us. Russia is operating us. As the president is going around the country dealing with upsetting Canada, places around the world. So I just want to know that where are we going? When are we going to have a chairman? Are we going to have it? And answer me truthfully. Has President Trump asked you to delay this appointment? And if so, why?
Sir, that statement is incorrect. He has not asked me to delay that appointment. And I believe that your question is, when are we going to have an FDIC nominee? And we have OCC nominees. We have a CFTC nominee. We have a vice chair supervision nominee.
Mr. Chairman,
I would ask you to urge your Senate colleagues to, on the Democratic side, to vote for them.
Thanks,
Well,
Secretary.
when is he gonna
Ms.
do
Scott,
it?
your time's expired.
All right.
Thank you.
Thank you.
Excellent discussion.
Thank you.
I recognize the distinguished chair of our Financial Institutions Subcommittee, Mr. Barr of Kentucky, for 5 minutes.
Secretary Besson, thank you and President Trump for, in February, issuing the National Security Memorandum entitled America First Investment Policy, directing federal agencies to address outbound investments.
You are listening
in China.
to Representative Andy
In
Barr,
March, as you
Republican
know,
from
Senator
Kentucky,
Cornyn and
questioning
I
Treasury Secretary
reintroduced my
Scott
bill,
Bessent.
to restrict outbound investment into China, specifically into Chinese military industrial complex entities, primarily through OFAC sanctions. Tell me, Mr. Secretary, what do you think about that legislation in the context of the president's national security memorandum?
Good, Congressman, I want to thank you for your leadership on this matter. My team and I appreciate your input and molding this important issue, one of the most important financial issues of our time. It is a new national security tool that we restrict the PRC from exploiting the benefits. And we appreciate that Congress wants to move forward legislation that is important and helpful. And we would like a bit more time for our process, including the work mandated by the president, to inform the legislation so that it is durable because of the importance of this.
Well, thank you, and I look forward to working with you and the president to align our legislation with the president's policy on this. And I want to give you and President Trump another tool of economic statecraft to increase President Trump's leverage in his negotiations with General Secretary Xi. This is a very important issue, and as you probably noticed, there was recently a $75 million venture investment into a Chinese artificial intelligence firm, Manus. Is Manus AI on the CMIC Treasury entity list?
I will have my staff get back to you on that, sir.
And I think the answer is no, and that's why we need this legislation so that our outbound restrictions look not just at entities but also technologies of national security concern, like militarized artificial intelligence that this entity Manus AI is doing. I would also note that the waiver authority that I embed in this legislation with Senator Cornyn would give you, as Treasury Secretary, the ability to authorize BlackRock or other U.S. firms to invest in Panama to displace the Chinese. So thank you for your collaboration with us on that. Secretary, you said that with President Trump, we're going to re-privatize the American economy. That is music to my ears. That's music to the American people's ears. When federal bank regulators are talking about re-proposing the Basel III Endgame proposal, they have been saying now for a long time we should do it in a capital neutral way, abandoning former Vice Chair Barr's approach of a huge gold plating of bank capital. Since the Federal Reserve started to use the term capital neutrality in 2019, however, capital has increased by 10 to 20%, making the concept of capital neutrality really arbitrary. Large banks are now subject to stress tests, CCAR, GSIB surcharge, and a number of liquidity and resolution requirements. When looking at our bank capital regulations in the context of an America First agenda, Mr. Secretary, should we be aiming for capital neutrality, or should we be instead looking at capital levels that actually promote American competitiveness?
Congressman, as you know, I've been very concerned about our community banks or small regional banks and the growth of private credit outside the regulated system tells me that many of the regulations may be too tight and that the business is pulled into the so-called shadow market. I think we want to safely and soundly expand the regulated financial system and get them on equal footing. And I think that these capital levels that are predictable are very important for that.
Last question about China investment in Venezuela. Last week, Venezuelan Vice President Rodriguez asked Chinese officials to increase oil purchases as the country is feeling the squeeze on its energy sales. Tell me what you think about OFAC licenses for U.S. Companies operating in Venezuela when those American firms could displace China to enhance American energy dominance.
It is a very acute balancing act there between displacing China, but U.S. entities providing hard currency for the Maduro regime, and we are constantly.
Gentleman's time has expired.
I look forward to working with you on that issue.
Thank
you. I yield back.
Recognize the distinguished gentleman from Massachusetts, our ranking member of the Digital Assets, Financial Technology, and Artificial Intelligence Subcommittee, Mr. Lynch, for 5 minutes.
Thank you, Mr. Chairman. Mr. Secretary, thank you for coming before this committee and helping us with our
Stephen
work.
Lynch, representative of
Mr. Secretary,
Massachusetts.
between March 11th and March 15th, 2025, you and more than a dozen senior officials, including of the Trump administration, including Secretary Hegseth, Director of National Intelligence, Tulsi Gabbard, National Security Advisor Mike Waltz, used a commercially available, non-governmental, encrypted, non-secure app to discuss and coordinate imminent U.S. military strikes in Yemen in a group chat entitled Houthi PC Small Group. Particularly, Defense Secretary Hegseth shared actionable intelligence, including sensitive and classified details of an imminent military operation against Houthi rebels and other military plans. These included precise launch times for U.S. jet fighter assets, targeting locations for those Houthi rebels who were, by the way, equipped with anti-aircraft systems. Mr. Hegseth shared the targeting sequencing against Houthi rebels and described the weapon systems, the U.S. weapon systems involved. National Security Council has confirmed that this signal chat was authentic and that you had participated. You realize that for you, Mr. Secretary, because of the responsibilities you have, even outside the Principals Committee, that group, you have a target on your back from our adversaries, China, North Korea, Russia, and others. Can I ask you, have you been briefed on the proper protocols for discussing information such as active military plans?
I have by my general counsel.
Very good.
If you will look,
I got a bunch of questions. So I'm just trying to narrow this down because this is really a concern. Just reclaiming my time.
To that chat was.
Let me ask you.
My chief of staff's name, which was widely available.
Let me ask the questions and you provide the answers. Okay? How about that?
Waiting for the question.
Are you preserving records, Mr. Secretary, of these communications as required by the Public Records Act?
Yes, sir. My general counsel has photographed.
Are you still discussing sensitive military intelligence on a non-secure line?
I have never done that.
Okay. The National Security Council says you were on a chat that discussed those details. Are you saying that wasn't the case?
I have said that I have never discussed them.
Someone discussed it with you. You were on that. You were on a non-secure line for a meeting with other secretaries, right? Those people I just mentioned. You weren't on that chat.
I was, but
you okay? That's what I'm talking about. So you could have intervened. You could have brought it up. You could have said this is an insecure line. We shouldn't be doing this. We're putting our sons and daughters in uniform at risk. Pre-attack. You could have done all that. Mr. Hague said this is not involving you, but Mr. Hague said afterwards did the same thing with a family chat. His wife, his brother, his sister, family attorney. You do understand the troublesome nature of that, right? Are you dismissing that and calling this a roaring success, as others have done, as the White House has done? This is troubling, and I just want the reassurances for this committee and for other members of Congress, other committees, and for, most importantly, for the families of Americans who send their sons and daughters, into harm's way. They put on that uniform. I just want the reassurances that we're not doing, this buffoonery has to stop, right? At some point, there are serious consequences for not complying with security protocols. Mr. Secretary, you're a smart guy. You're a smart guy. You didn't create this situation. You were drawn into it. I'm just trying to reassure the committee that this stuff is not happening anymore.
Gentleman's time has expired.
Allow the gentleman to answer. Be a yes or no.
I think the gentleman's time has expired.
Well, Congressman, I'm happy to say that because of my age, I pick up the phone and call people.
There you go.
Gentleman's time has expired.
You've been listening to Treasury Secretary Scott Bessent speaking with the House Financial Services Committee. We will get back to that in just a moment, but I think it's worth pointing out that tech is starting to trade a little heavy, so we wanted to give you a data check here with John Tucker.
Yeah, the major stock averages, Alex and Paul, they've turned from higher to mixed right now, and shares of Google parent Alphabet seem to be setting the tone right now. The shares are down 5.8%, and this slide comes after an Apple executive, Eddie Q, was testifying. He said the iPhone maker is exploring additional AI search features to its browser, adding AI search. So Alphabet facing the possibility of stiff competition. Again, Alphabet shares, Google parent, down 5.8%. Overall, the S&P 500 is down 1 point. The Dow is up 188 points, and the NASDAQ 100 right now 66 points lower. That is down 0.3%. So we have now turned mixed in the markets, Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's get that back down to Washington, D.C. Treasury Secretary Scott Bessent testifying before the House Financial Services Committee. We have Barry Loudermilk, the representative of Georgia, is now questioning Treasury Secretary Bessent.
Well, I would say that the unfettered ability to borrow has made us more prolific, as there is very little potential for market discipline to date. Right? There is the potential that the market may discipline the United States government one day, and I am, along with the administration, President Trump, trying to set the country on a path to avoid that.
And we appreciate that. I've long said that I don't feel that there is the political will within Congress anymore to restrict spending and balance the budget. And so I appreciate the work that you're doing there. Is there a world where we can have our cake and eat it too? In other words, is there a policy configuration where the U.S. can maintain the best elements of its exorbitant privilege while also having a balanced export economy?
Yes, sir, there is. And I would point out that the exorbitant privilege, as I believe it was a French politician called it, does not always result in the lowest interest rates. Japan's interest rates are lower than ours. China's interest rates are lower than ours. Most of the EU interest rates are lower than ours.
Okay.
I want to shift gears just slightly. For several years, I've called for FinCEN to raise the threshold for currency transaction reports from 10,000 to some higher value. Working on legislation have been for the last several years, and I do have legislation again this year on that. If adjusted for inflation from the 1970s, this threshold would be somewhere between $74,000 and $80,000. But we haven't. We're still stuck at that $10,000 limit. In your opinion, what threshold value best balances privacy and compliance costs against the utility that these reports have for law enforcement?
Congressman, I am not sure what the equilibrium level is. What we have discovered, so you were talking about the threshold for a suspicious activity report.
Or the concerns, currency transaction report, yes, which is in a second.
So we are now examining that, and we are finding that sometimes higher is better, sometimes lower is better. We have discovered that there are approximately 40 counties on the U.S.-Mexico border that account for a substantial amount of nefarious behavior by the cartels. So we have lowered that to $200, and we are finding great efficacy there in pushing the cartels back into Mexico and not allowing them to deal in the United States. So I would say, sir, it's a moving target.
Okay, and I can understand and appreciate that. One of the issues that we have from a nationwide status is the compliance cost that goes to small financial institutions, and even from law enforcement, the complaint is trying to find illicit financing currently is like looking for a needle in the haystack because of the pure volume of reports that are being made. And so my argument has been from in a nationwide status, and I'm sure we can work on something to make exemptions during times like you're talking about now in locations, but is not to increase the size of the haystack, but reduce the haystack so it becomes more prevalent, the illicit financing.
And look, Congressman, I am the hypersensitive to the needs of the small and community banks and the undue burden that much compliance is placing on them. And we are working across a variety of ways to lower that cost.
All right, look forward to working with you on these things.
Thank you. Gentleman yields back. The ranking member on the Oversight and Investigation Subcommittee, the gentleman from Texas, Mr. Green, is recognized.
Thank you, Mr. Chairman. Thank the ranking member, and I thank the witness for appearing.
Right now we're listening to Al Green, a representative from the state of Texas.
When you testified before the Senate, you indicated that the CDFI fund is a very important program. It's very important to us. Is this correct?
I did, sir.
And is it true that you would not agree that it is a woke program, it has cultural Marxism associated with it, and that it is abused? You wouldn't agree with that, would you?
Sorry, I think the CDFI fund is performing its statutory functions as required.
So you would not agree then that it's woke? Is it statutory function to be woke?
I've never seen that in the statute, sir.
Okay. What about Marxism? Is that associated with it in the statute?
Again, sir, I've never seen that.
Okay. Now, given that the president desires to cut into this program, you're the Secretary of the Treasury. What are you going to do about it to protect it?
Sir, the skinny budget does propose a new $100 million award program that will provide access to affordable financing.
Does that take care of the many billions that we put in, $12 billion to support the CDFIs? That's a lot. It's quite a distance from the $12 billion, sir. What are you going to do about it?
Look, I understand.
Do you advise the president?
Sorry?
Do you advise the president?
I advise the president on a wide range of matters.
Is this considered a part of a wide range of matters? Would you advise the president that he shouldn't cut these funds?
I look forward to working with you and the committee to ensure these programs operate efficiently for taxpayers.
What about efficiently for taxpayers and efficiently as a result of them being in place to do so? If you don't have the money, they can't be efficient. They can't serve taxpayers if you don't have the money. 61% of these programs are in Republican districts. question. Yes, it's a question in the sense that I'm asking you to suggest to the president that this is important and that you not cut it.
So the skinny, as I said,
100 million is quite a distance from 12 billion.
well, that's not the annual appropriate. 12 billion is not the annual appropriation.
No, but 12 billion is what we, a bipartisan group of folk, put into the CDFIs as well as into the minority depository institutions. We don't want to see that cut. Let's go to another area. Do you agree that when a tariff is imposed upon a product that's coming into this country, that the tariff is collected at the border?
Yes, sir.
And do you agree that that money that's collected goes into the Treasury's coffer?
Yes, sir.
And do you agree also that if the person that is importing this product is of the opinion that it is something that his clientele, his customers desire, that he will pay that tariff?
Yes, sir.
And do you agree that when he pays that tariff, he's likely to pass it on to his customers, his consumers?
Sir, the laws of economics would say that they're very elastic.
I understand, but do you agree that he is likely to do that? Do you agree that he does it sometime? Do you agree that he does it sometime?
Again,
do you agree that he ever do? Does he ever do it?
Sure.
So your position is, as the great treasurer you are, that this is not passed on to the taxpayers,
it could
the
be.
consumers. It could be. Well, is it ever? It's hard to say yes, isn't it? It really is.
It's not.
Don't listen, sir. You don't have to fear. Don't listen. Don't fear the president, sir. Is it ever passed on? Have you ever heard of this tax money being collected and passed on to the consumer to pay? Have you ever heard of that?
Well, the most recent studies from...
Okay, let's go on to this point. I have a better point to make. Excuse me, I'm reclaiming my time. I have a better point. Listen just a second. I only have a little bit of time. And when it goes into the coffers, that money is then going to be a part of the tax dollars that can be accorded to persons in terms of a tax cut. Is this true?
It's part of the overall...
Yes, it is true, which means that the consumer, the person who pays that tax, this tariff tax, when he makes that purchase, is going to put his money in your coffer, our coffer, and then the president later on can say, you got a tax cut, but it's really the money that the consumer has put into your coffer. That is true. I yield back.
The gentleman yields back. The gentleman from Ohio, the chair of the National Security, Illicit Finance, and International Financial Institutions Subcommittee, Mr. Davidson, is recognized for 5 minutes.
Thank you, Chairman. Mr. Secretary, I applaud your eloquent message at the Millikan Institute clarifying the Trump administration.
You are listening to Representative Warren Davidson, a Republican from Ohio, questioning Treasury Secretary Scott Bessent at the House Financial Services Committee.
Aligns completely with your efforts on illicit finance, on trade with the pending reauthorization of the Defense Production Act, the national interest with outbound investment laws and clarity, and on focused international financial institutions. I remain highly concerned about the future of money and frankly, probably the most important policy debate we're having. I'll save that part for future hearings, but on illicit finance, I applaud your FinCEN final interim rule, removing beneficial ownership reporting requirements for U.S. companies and citizens. The prior approach was collecting information on millions of Americans and companies, even homeowners associations, under the guise of illicit finance. Lots of noise and very little signal. By narrowing the scope of the rule, you are focusing on the signal. Given the shift in focus, millions of Americans have shared sensitive, personally identifiable information. Mr. Secretary, as the committee moves forward clarifying the rule, and would you commit to supporting the deletion of data already collected under the previous rule?
Sir, my staff is working on what will happen to that data, and we will get back to you on that.
Appreciate it. We work with you, and certainly hope you safeguard it always, but it'd be especially safe if it was deleted. Speaking of legislation, my bill, the Chinese Currency Accountability Act of 2025, it would require the Secretary, you in this case, to instruct the United States Governor of the United States Executive Director at the IMF to use the voice and vote of the United States to oppose any increase in the weight of the Chinese RMB in the basket of currencies used to determine the value of special drawing rights. This bill has passed the House on a bipartisan basis, most recently in February, and it still awaits Senate action. Mr. Secretary, far more effective than waiting for the Senate is your leadership on this issue. Will you advocate for opposing an increase in the RMB until China straightens itself out?
I'm look forward to working with Congress on this issue on whether additional legislation is needed to address the Chinese practices or whether it could be done through trade negotiations.
Wish you great success in your pending negotiations. And certainly, if you look at the IFIs, things like Argentina's recent restructuring under the IMF basically bailed out the Belt and Road. They'd never really have to worry about default at the Belt and Road. They're using their influence in the international financial institutions like the IMF and the World Bank to frankly cover risk at the Belt and Road. So hopefully that'll be restructured. You've already covered Outbound, and I really appreciate the dialogue on that. But I'd like to turn to the Defense Production Act. I mean, when you look at how you've organized and communicated the president's approach there and the administration's approach, national security is of course paramount to that. And as we organize and update and reauthorize the Defense Production Act, of course it deals with the Department of Defense, deals with Commerce, who does a lot of these things, but it's been structured under the authority of the Department of Treasury. Would you commit to working with our Committee on National Security and Finance to gather the input and get a final reauthorization across the finish line this year?
I think that is an important piece of legislation. We look forward to working with you on that.
Thank you, Mr. Secretary. And then lastly, you've spoken eloquently about the kind of mission creep that comes in to some of our international financial institutions. And as you know, the IMF set up a climate fund in 2022 known as the Resilience and Sustainability Trust. Given concerns about IMF mission creep, will you work with to eliminate RST so that the IMF can get back to its core mission?
Congressman, at my speech during IMF week, I stressed the need to get back to basics at all of the multilateral development banks, especially the IMF.
Yeah, thank you. And I mean, the World Bank's spending a massive amount on that. And as Chairman Hill and I met with the Inter-American Development Bank, they highlighted things that they were doing to deal with natural disasters that are important for tourism for them. So some of this is characterizing things that are really infrastructure for those countries as climate change, maybe to appease the previous administration. I'm confident you'll get it right to the extent we can be helpful in that as we reauthorize these programs, and we consider doing it. I thank you for your clarity talking about American leadership there so that America's interests are focused with the use of Americans' resources. I thank you for your steadfast work and your testimony today, and I yield back.
The gentleman yields back. The gentleman from Illinois, the ranking member on the Financial Institutions Subcommittee, Dr. Foster, is recognized for 5 minutes.
Well, thank you, Mr. Chairman and Secretary Bessent, for your appearance here today, as well as your very nice courtesy call.
To Bill Foster, representative from the state of Illinois. Treasury Secretary Scott Bessent testifies before the House Financial Services.
I'd like to speak today about the strength of the U.S. dollar and the decline of U.S. manufacturing, which, as you know, I'm very concerned about. I started this company back when I was 19 years old that now provides over 1,500 manufacturing jobs in the Midwest. And it's not been easy. We started our company in the beginning of the Reagan inflation. Then we had to live through all of the Bush policies and the China shock that occurred on his watch. We lived through just all the ups and downs of this, and it's not an easy thing. And now, in terms of the strength of the dollar, it's affected by many things. It's including central bank policies, interest rates, tariffs, and the balance of trade. But in the long run, I believe that the strength of the dollar reflects the world's confidence in the U.S. economy, in the competence of U.S. leadership, and the value of products made by American workers, and our reputation as a fair place to do business and the rule of law in America. Now, Secretary Bessent, earlier this week, you ran an op-ed in the Wall Street Journal echoing many of the points you made in your testimony. And in that op-ed, you promised, inter alia, more jobs, more manufacturing, more deregulation, lower taxes, less national debt, all while maintaining a strong dollar. On the other hand, Stephen Miran, Trump's choice for the chair of the Council of Economic Advisors, wrote a paper last year arguing for weakening the dollar, through something he called the Mar-a-Lago Accords, which you've reportedly been placed in charge of negotiating. The president himself has just been all over the map on almost a daily basis on whether a strong dollar or a weak dollar will make America great again. So my question is, what is it? You know, does the administration support a strong dollar or a weak dollar?
Sir, I'll work a little backwards. C. Head Myron paper was when he was in the private sector, and I think it related to a range of outcomes. Two, that I believe that the conditions for a strong dollar, they are important for international confidence. And again, when we think of strong dollar, what is a strong dollar? Is it the composite on the Bloomberg of all currencies? Is it a trade-weighted dollar? And then we can also look at bilateral relationships, because much of that could be not so much a strong dollar, but other countries manipulating and suppressing their currencies, which would...
We lived through that in the Bush administration and as non-reaction to what China was doing. I know all about that. But I think it's interesting to look at the historical record here. And I think, you know, I have behind me, you know, a plot of the strength of the U.S. dollar under recent presidents. And I believe your staff has a copy of a one-page handout that could be given to you if it's easier to read. And what it says is remarkable. That it says that under every president, from every Republican president, Reagan, Bush Jr., Trump 1, or now Trump 2, the dollar has weakened. Under every Democratic president, without exception, Clinton, Obama, Biden, the dollar has gone up significantly. And I don't think that's an accident. I think it's because of all the factors, including predominantly the confidence that the U.S. will maintain a well-regulated and well-governed economy and a fair place to do business. Now, and also on that handout, which I think has that actually been given, do you have the copy of the handout with the graphs on it? It's double-sided, single page. We can get you another copy if you want. And it also has, you know, the argument in favor of a weak dollar. It should make manufacturing easier in the United States, make our, you know, that's one of the arguments for it. But if you look at the historical record here, if you just look at, for example, change in manufacturing employment under Democratic and Republican presidents, it's remarkable. For longer than you or I have been alive, Democratic presidents have increased manufacturing employment and Republican presidents have decreased manufacturing employment. You know, from FDR, Truman, Kennedy, Johnson, Carter, Clinton, Obama, and Biden, all increased manufacturing employment. Eisenhower, Nixon, Ford, Reagan, Bush 2, it all dropped. Okay, I don't think this is an accident, but the thing I want to ask you about is how did the Republicans manage to weaken the dollar and weaken manufacturing employment at the same time? Because it seems like that's completely crossways to the narrative that we're hearing from this administration.
Well, sir,
the gentleman's time has expired. The gentleman's time has expired. The secretary can answer in writing. The gentleman from Tennessee, the vice chairman on Oversight and Investigation Subcommittee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairman Stile, and I want to thank Chairman Hill and Ranking Member Waters for holding
John Rose, the representative from the
Secretary
state of
Bessent,
Tennessee.
thank you for being here with us today and answering our questions. Secretary Bessent, given that the Mint, the U.S. Mint's own fiscal year 24 report shows that the nickel, the U.S. nickel now costs 13.78 cents to produce, and that experience in other countries suggests that our nickel production or demand would double, triple, maybe even multiple times beyond that if we eliminate the penny. Is Treasury analyzing the risk that stopping penny production alone could actually worsen our coinage losses or seniorage losses by pushing annual nickel losses well past $200 million?
Congressman Rose, that we have looked at this and we believe that it is possible by changing the composition of the nickel to bring down the cost to 5 cents or less.
Absolutely. That was going to be my next follow-up question to you. So
I will point out that the dime is very profitable.
Yes, and you know, it'll sound like a little self-interest, but a Tennessee company is one of the folks that could lower the cost of the nickel and has made a proposal that I know
we're investigating that with them and are very intent on maintaining those jobs, sir.
And I would just say from my deep dive into both penny and nickel production, it seems to me that there are significant savings beyond just saving on composition of the nickel. So I would encourage Treasury and the Mint to take a look at refocusing how we produce those coins to make them actually positive for the balance in terms of producing seniorage for the United States. So I'm glad to hear that you're moving in that direction. Secretary Bessent, the president has recently made budget requests that propose significant cuts to the Community Development Financial Institutions, or CDFIs, or the CDFI fund, and suggests to end core CDFI programs. I know you've recently made public comments about the statutory basis for the CDFI programs. What is your position on the future of the CDFI fund, and do you believe it should continue to play a role in supporting access to capital in underserved communities across the country?
Well, the congressman, as I told the congressman on the other side of the aisle, that we are creating a new $100 billion award program that would provide access to affordable financing, and this will be mostly in rural America.
Excellent. I'm glad to hear that, and I understand we always need to be addressing how these programs work and whether they're efficient and cost effective and produce the outcomes we want. But I am glad to hear that you're making moves in that direction. And I just want to pause at this point and say broadly, it is refreshing to have competent, aggressive, energetic leadership. And so I commend you for that, and I'm very excited about the things that you're doing at Treasury. Secretary, can you discuss the significance of confirming President Trump's regulatory appointees in advancing his America First agenda? Specifically, how do these appointments impact the implementation of these important policies to move America forward?
Yes, sir. I believe that we need to get them appointed as soon as possible. We have some very good acting, the chairs or directors of these, but the sooner we can do it, the sooner we can get down to the business of making these institutions work better for the American people and making sure that Main Street can prosper, because I've been very concerned. As I've mentioned today, I've met, I think, the personal meetings with over 50 community bankers. I spoke to more than 300. And I think it's very important to get these regulators in place so that community banks, small regional banks can make sure that Main Street participates with the rest of the country.
Thank you. I completely agree, and that's what we're hearing, I'm hearing from the regulated entities in my district and across Tennessee. Secretary, given the IMF's limited success in pushing China on transparency and debt restructuring, how can Treasury justify supporting the IMF's current leadership?
We are in constant discussions. It is leadership that I inherited. Thus far, they seem very open to the Trump agenda, America First, and advancing the issues that most affect the United States and working Americans. So we will keep pushing them on that.
Thank you, Mr. Secretary. Mr. Chairman, I yield back.
The gentleman yields back. The gentlewoman from Ohio, the ranking member on the National Security, Illicit Finance, and International Institutions Subcommittee, Ms. Beatty is recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member, and to
you were listening to Representative Joyce Beatty, Democrat from Ohio, questioning Scott Bessent, Treasury Secretary.
Deterring transnational criminal organizations such as Iranian terrorist groups and their proxies is a priority for national security. But on March 2nd of 2025, your department announced that it would not enforce any penalties or fines associated with the BOI reporting rule, nor will it enforce the CTA against U.S. citizens, domestic reporting companies, or their beneficial owners. So I'm a little confused of how you square those two things. So my question is, can you explain to, or would you explain to the American public how you undermine the bipartisan CTA and expect law enforcement and national security agencies to quickly and effectively know the true owners behind shell companies registered in the United States now that foreigners, including a drug cartel, gang members, could register a company in the United States with no state or any federal ownership reporting requirements. And I remind you in your testimony, you talked about illicit actors. Well, these are some of our illicit actors.
The Congresswoman, an overwhelming majority of the domestic entities that you're describing are hardworking Americans with small businesses. We bifurcated the bill, and any foreign entities must still file.
So you saying to me it's not true that they must file and the foreign entities must file the BOI?
Yes, we bifurcated the CTA program that domestics do not have to.
So maybe I'm asking it the wrong way. So it appears that they are doing it registering to avoid the transparency of who the companies are.
I'm not sure what your question is. I'd be happy to answer it.
So I guess I'm looking at it as, and if you're saying it is not true and that they now are complying and completing the BOI. So let's take it one step at a time. So you're saying everybody is completing the BOI. You're enforcing it.
No, ma'am. I am saying that we have bifurcated it, that U.S. nationals do not have to file, and that foreign nationals do.
Okay, so I guess when we look at this, if we're limiting enforcements of the rule just to the foreign entities, that creates a giant loophole whereby any foreign entity can register in the United States and evade or not do the BOI reporting requirements.
Well, they would be subject to they would have to come through a U.S. financial institution, so they would be subject to all U.S. institutions.
Including the BOI.
Including
the BOI. Including the BOI, yes or no? Because the answer is no. I mean, you can say it however you want to, but the answer is no. And this makes it easier, and this is what I want the American folks to know. It makes it easier for human and drug traffickers, cartels, terrorists, organizations, and other criminals to do business in the United States. And when you're limiting the enforcement just to foreign entities, it exempts 99% of the entities that Congress intended the law to cover when it was passed into law. So I think I do have my answer. We're just not agreeing on it, and you know why. So let me go to my second. It's my time. Let me go to my second question. The clock is running. It's my time. It is my time. You will not do this on my time. Now, I'm going to ask for a few more seconds since he refused to comply with my time, not his time. In 2016, former Secretary Jack Lew announced that Harriet Tubman was to be the new face of the $20 bill. Can you tell me what's the current status of this project?
No, ma'am, I can't, but my staff will get back to you.
No, I want you to get back to me. Because, see, there seems to be an issue when it comes to things that affect people of color or people who live in poverty, whether it is what you're doing with Social Security, what you are doing with restricting funds.
The gentlewoman's time is expired.
The gentlewoman's time is expired.
The gentleman
Mr.
from
Chairman,
Texas,
I need him to answer if he will. I'm not a staff person. I'm not asking him to have his staff report.
The gentlewoman.
So, Mr. Chairman, I'm addressing it to you to ask him to respect me. Mr. Chairman,
the gentlewoman's time has expired.
I need him to address if he will answer me. No, I'm not going to.
The gentlewoman's time
I'm
has
not
expired.
going to stop until you direct
The gentlewoman's
him
time
to
has
answer
expired.
to me as a member of Congress.
The gentlewoman's
Mr.
time
Chairman,
has
point
expired. The
of order
gentlewoman
to
has
you.
offered that she can submit
Mr.
questions
Chairman,
for the
point
record.
of order to you. I will not stop. I will not be silent
gentlewoman's
until
not
you
offering
direct
an
him
appropriate
to
parliamentary inquiry. Does
Will
the gentlewoman
you-
have a parliamentary
Yes,
inquiry?
I do.
Please state the parliamentary inquiry.
As a member of the United States Congress addressing the Secretary, I am asking you to rule on asking this hostile witness to direct his response to me versus having him tell me that his staff will respond. My staff person didn't ask him the question. I did.
The gentlewoman does not state a parliamentary inquiry.
So let me ask the
Gentlewoman's
point of
time
privilege to you, Mr. Chairman, because I'm not going to stop this morning until you respond to me then, if you will direct the Secretary to respond to me as a member of Congress. Or let me ask
It is
him.
not a
Then
point of
let me
privilege. The
ask
gentlewoman's
him
time. The
if
gentlewoman's
he will
time has
respond
expired.
to
The
me.
gentlewoman
Will
will
he
suspend.
respond to me?
The gentlewoman will. The gentlewoman will suspend. The gentlewoman
It can
will
be simple
suspend.
if he responds.
The gentlewoman will suspend.
If he responds
Gentlewoman
to me,
will
if
suspend.
he will
The
respond,
gentlewoman makes a legitimate request, a personal
you
privilege.
can simply ask him to
Grant
respond.
personal privilege.
Just
Personal
ask him to respond if he'll respond to a member of Congress versus saying a staffer. It's simple as that.
I ask that members keep decorum and remain cordial during today's hearing.
I am being
Members,
cordial
the
to
gentlewoman
you,
will
Mr.
suspend.
An exchange
The chair
here
has the
with
time.
the Democratic
The
Congresswoman
chair has
Joyce
the
Beatty
time. The
of
gentlewoman will
Ohio
suspend.
Gentlewoman
The
makes
and
a
Congressman
gentlewoman
Brian
will
Stile, who is
suspend.
standing in his chair
I
at this
ask that
House
members
Financial
keep decorum
Services
and
Committee
remain
hearing in
cordial
which the
during
Secretary
today's
of the
hearing.
Treasury, Scott Bessent, is testifying.
That I am not. I am a member of the U.S. Congress. I am asking this
The
secretary
gentlewoman
to
may
respond
submit
to me.
QFRs for the record, which will be responded to by the secretary.
Thank
The
you.
gentlewoman's time has expired. The gentleman from Texas, the chairman of the Small Business Committee, Mr. Williams, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Secretary, for being
And
here.
now
This
we
may be
move
a
on
little
to
easier
Republican
here.
Congressman
I'll
Roger
fast
Williams
forward.
of Texas,
The
questioning
Chinese Communist
Secretary
Party has
Bessent in the
enabled
House
their
Financial
economy to
Services
serve
Committee.
as a central hub for money laundering, human trafficking, and the export of chemicals used to manufacture fentanyl. Increasingly, Chinese nationals and financial works have informed operational alliances with Mexican drug cartels, providing laundering services, digital payment platforms, and chemical shipments that fuel the trafficking of fentanyl across our southern border. These criminal partnerships exploit the international financial system and pose a direct threat to U.S. national security, public health, and financial integrity. So my question, Mr. Secretary, is can you elaborate on the steps Treasury is taking to disrupt the flow of illicit financing, money laundering, and drug trafficking between Chinese entities and Mexican drug cartels?
Thank you, Congressman, for that very important question. And note that they are interlinked, that the Chinese provide precursor drugs that are then converted into fentanyl by the Mexican cartels. And just today, I signed an order that will be made public within the next few days, identifying Chinese entities who are engaged in the fentanyl trade.
Great. For too long, China has taken advantage of the international financial system and has become the world's largest creditor. The IMF and World Bank's focus on climate and social initiatives has resulted in a lack of accountability for the Chinese unreliable economic data, currency manipulation, and opaque predatory lending practices. In addition to the lack of accountability, this shift in focus to climate has forced many developing countries to turn to Chinese financing. The United States must leverage its leadership of the world stage to counter China's growing influence as a global lender and put an end to the deceptive economic practices. So, Secretary, how is Treasury working to prevent IMF and the World Bank resources from indirectly legitimizing China's debt trap, diplomacy, and economic oppression?
Well, Congressman, in various ways. One, as you would have noticed, I will have said that when this horrible Russia-Ukraine conflict ends, that no one or pays bills, and it is able to know. We don't know the true levels, or if there is an undisclosed priority payment to a another creditor.
Let me try to get to my last question. I was encouraged to hear that you are taking a fresh look at the bank regulatory framework to better reflect actual risk and ensure a level playing field across the financial system. And as part of that review, I hope you'll consider where U.S. regulations may be putting banks and financial institutions at a disadvantage compared to our foreign competitors. In particular, I urge you to weigh the combined impact of proposals like Basel III Endgame, the GSIB surcharge and leverage requirements, especially whether these changes could limit banks' ability to support the economy and compete globally. So in your work so far, are there any specific areas where you plan to address these concerns about regulatory putting U.S. institutions at a disadvantage, such as in the re-proposal of the Basel III Endgame rule by amending the GSIB surcharge regulation?
Congressman, we are looking across all areas and know that this is at the top of our agenda, that most countries have very concentrated banking systems. In many cases, the banking systems are larger than the GDP of the countries, so they have very different needs than the United States. The strength of the United States, lending and capital markets and economy, is the breadth and depth of our financial institutions, and we will continue to advocate for them both at home and abroad.
Thank you for your service. I think you're doing a great job. I yield back.
The gentleman yields back. The gentleman from California, the ranking member on the Task Force on Monetary Policy, Mr. Vargas, is recognized for 5 minutes.
Thank you very much, Mr. Chair and Ranking Member, for holding this hearing. Mr. Secretary.
This is Democratic Congressman Juan Vargas of California questioning Treasury Secretary Scott Bessent in the House Financial Services Committee, heard live on Bloomberg.
You consider Vladimir Putin a war criminal?
Yes.
Would you negotiate with a war criminal?
I think that's the nature of diplomacy. One must negotiate with both sides, sir.
So you will be negotiating then with the war criminal?
I believe that negotiation was needed with the Japanese after World War II.
Okay. Thank you for that answer. Are you familiar with what President Trump has called his One Big Beautiful Bill?
Yes, sir.
Could you describe the basics of that bill?
It is a combination. The core of that bill is to make the 2017 Tax Cuts and Jobs Act permanent.
If this, what he quotes, a big, beautiful bill passes, will the deficit go up or will the deficit go down?
I believe over time, the deficit to GDP, which is the important number, even Secretary Yellen agrees with that, will stabilize and go down.
So next year, will it go down?
Sir?
Yes.
I believe, yes.
You say, so if the big, beautiful bill passes, you believe the deficit will go down next year?
The deficit to GDP will. Because again, what is important is that we grow the economy faster than
I understand that. I understand that, of course. But you say that in the long term, I'm asking in the short term, will the deficit go down?
I believe the debt to GDP can go down.
But what about the deficit itself? The amount of money that comes in as opposed to goes out. Will the deficit go down next year?
Will it go down from 2024 and 2025? I believe it will, because these are extraordinary levels.
What about the long-term debt? Will it go up or down if this big, beautiful bill passes?
Again, sir, it's while the absolute...
I think the reason you're having a hard time answering...
I'm not having a hard time answering, because what is important...
I've given you plenty of time.
...isn't the absolute level of debt. It is, as Secretary Yellen said, the debt to GDP. So that if our GDP were 100...
Everyone is talking about the $37 billion. Is it going to go up or down?
Sir?
Yes. Is it going to go up or down?
It will likely go up, but if the GDP goes up faster,
I think that's the interesting thing. My colleagues on the other side always talk about reducing the debt and reducing the deficit, and yet the hypocrisy of trying to pass the big, beautiful bill that will cause both of them to go up.
No, sir, I did not say the deficit.
No, I know you didn't say it. You're trying not to say it, but that's exactly what's going to happen.
I actually said it would not go up.
I know you did.
Just to be clear.
You said the number would go
just
up.
To be clear, last year, 6.7% deficit to GDP.
No, I'm asking the number. I'm asking the actual number. No, we're looking at, see now.
Previous administration.
No, we're asking about numbers here, Weldon.
When we were not in a recession and
I'm not gonna let you get away with that one because it's very clear what's gonna happen if they pass their bill. The deficit's gonna go up and the debt's gonna go up. And we're going to see the hypocrisy of them always saying, cut the budget, so the deficit's going to go down and the debt's going to go down. It's not. It's going to go up. Now, I do want to ask you about the independence of the Fed.
Yes, sir.
You have kind of been on both sides of the fence on this. You seem to say that we need an independent Fed, but at the same time, you said there should have been a shadow Fed.
Sir, since taking office, I have refrained from commenting on Fed monetary policy, and I have said that monetary policy is a jewel box that must be preserved.
Okay, great. And lastly, I do want to ask this because a number of my colleagues have brought it up about elite, the coastal elites. Where did you go to school?
Sorry? I grew up in Little River, South Carolina.
And what university did you graduate? You graduated from Yale. You were part of Wolfhead's Society,
Congressman,
one of the big three.
Congressman, I worked 3 jobs to put myself
believe me, I grew up just as poor as you did. I understand that too. So but the thing that I always get is, the funny part is, I always talk about the coastal elite. You're a billionaire that went to Yale. I don't hold that against you. I just find it interesting that my colleagues are always talking about the coastal elites, and yet the president and yourself are both coastal elites.
And I made all my own money, sir.
The gentleman yields back. I recognize myself for 5 minutes for the purpose of asking questions. Secretary, thank you for being here. Earlier today, you referenced the electric slide. I'll share my concerns that during 4 years of the Biden administration, we were sliding behind foreign competition.
This is Republican Congressman Brian Stile of Wisconsin questioning the Treasury Secretary Scott Bessent on the House Financial Services Committee hearing heard live on Bloomberg.
If we object, if we walk out of that type of leadership role, which I think is so essential, to make sure that the United States continues to lead the way in Web3 as we did in Web2. And in particular, how does the leadership in digital assets play into President Trump's broader agenda? And specifically, how do dollar-denominated stablecoins impact dollar dominance in Treasury markets?
Congressman, thank you for that very important question. Our goal is to encourage firms to reshore, bring back to the United States best practices, their digital asset innovation and experimentation here in the United States without scaling back their ambition to influence the global industry. The administration's efforts to promote clear regulatory frameworks for digital assets will contribute to this goal. So will ongoing efforts to promote fair access, interoperability of payment technologies across all borders. We will continue to support private sector solutions and discourage public sector solutions that distort markets and stifle competition.
Let me jump in. Let me jump in because I think that's spot on. And then let's talk about what happens if we fail to act. Yesterday, some members objected, walked out of a hearing to discuss market structure and digital assets, an absolutely essential leadership role the United States has to play. What happens if we walk out on our responsibility to lead in the digital asset space, and what would occur if Web3 center of gravity shifts away from the United States to countries like China or other locations?
Well, numerous things could occur, sir. As we saw under the previous administration, an entire ecosystem, the unregulated and renegade, springs up outside the U.S., and illicit actors abuse the value of these transfer systems, and there is a technological loss here.
And can you walk us through or share any of your impressions from the conversations you've had with your counterparts abroad as it relates to their experience with regulating in the digital asset space?
They believe it's very important, and I believe that they are a little worried that the U.S. is willing to restore its leadership here. And as I said earlier, there is a chance that digital assets can provide a substantial source of demand for the U.S. dollar.
In my bill, the Stable Act, which regulates dollar-denominated stable coins, we give the Treasury the authority to identify which foreign stablecoin regulatory regimes are comparable to ours. What are the key aspects of comparable regime, and are there lessons or criteria that we can draw from other similar areas in the financial services space?
Congressman, I think that we have the blueprint with the bank regulation and adherence to anti-money laundering laws around the world, financial stability, and I would guess that 70% of the countries would be very easy to judge yes, no, and then there will be another group. That's why I believe that some of the bills encourage phasing this in.
And a lot of stablecoin, a lot of digital asset space needs reliable banking services. Could you comment briefly on how the Treasury is working with bank regulators to ensure that financial institutions can safely participate in this emerging industry?
We have recently delivered a report to the president on this. So we have safe and sound best practices, and we want to work with the financial industry, with new companies and entrepreneurs, as well as incumbents. The banks, there is a solution to banks to participate in this business, whether it's through custody or their own coins.
Let me shift gears really quickly in my final 30 seconds. President Trump issued an executive order on modernizing payments to and from Americans' bank accounts. The executive order noted that the Treasury checks are 16 times more likely to be reported lost or stolen or returned as compared to electric transfer funds. Do you think we're making real progress in this space?
We are working all speed ahead. Congresswoman from Staten Island told me of numerous losses of checks in the postal system, and it is both cost-cutting and good practice, sir.
Thank you very much. Thanks for being here today. I now recognize the gentleman from Texas, Mr. Gonzalez, for 5 minutes.
Mr. Secretary, thank you for joining us this morning.
This is Democratic Congressman Vincent Gonzalez of Texas questioning Scott Bessent, the Secretary of the Treasury, heard live on Bloomberg as he speaks in the House Financial Services Committee.
More than any other sector, this decline is attributed to a combination of factors, but mostly attributed to the tariffs. At a recent Dallas Federal Reserve meeting, a veteran CEO, energy CEO, said, quote, "I have never felt more uncertainty about our business in my entire 40 years in the industry, and this turmoil is no accident. It's a direct result of Mr. Trump's vandalism." Just yesterday, Diamondback Energy, one of the largest Permian producers, told shareholders that tariffs are adding significant cost of drilling activity. That's mostly due to the tariffs to our neighbors to the north and the south. Mr. Secretary, the chaos in the energy sector has eclipsed any gains from President Trump's industry-friendly regulatory rollbacks that they were so much looking forward to. Stable energy prices depend on stable policy. The Trump administration pledged to support American energy sector. However, this decline demonstrates the opposite. Given these outcomes, how do you reconcile the administration's stated support for energy sector with policies that appear to have directly undermined its stability and global competitiveness?
Sir, I would take issue with the idea that it was tariffs. We have seen one of the largest decreases in the underlying price of crude in history.
That's right.
So,
100%. There's not a single energy CEO in America right now that would agree with you. They are all attributing their downfall right now, the troubles that they're having, to the tariffs, and they need some relief. What's the administration going to do?
Congressman, you and I must speak to different energy executives because I speak to them quite often.
Well, I spoke to API today.
I will note that OPEC has done a substantial supply increase, and the history of substantial OPEC supply increase.
And the tariffs are just making it worse. China is no longer buying our LNG, neither is a lot of other countries around the world.
So, I think we've seen Harold Hamm, the head of Continental Resources, has said that he is reshoring his supply chain, and he believes that over time he did not save any money by outsourcing the equipment.
Secretary,
overseas.
Our energy industry is hurting. and they need your help. And I know you're a smart man and you're one of the most stable people in this administration. You need to talk to the president about this. This is hurting the industry and it's hurting the American people, and more needs to be done. I have another question that I want to talk to you about that's hopefully a little easier, and it has to do with our shrimping and fishing industry. As you may know, our domestic shrimping and fishing continue to experience economic hardships caused by an increase of foreign imports, high fuel prices, labor shortage, immigration regulation, all to make matters worse. Plus, we have flooded the domestic seafood markets with foreign farm-raised shrimps, many which are subsidized by by American federal dollars in the international financial institutions. We need to put an end to this. What are we doing in terms of tariffs to helping this industry that is hurting? I mean, if we want to talk tariffs, there are some that work, and I think this is certainly an industry that needs a lot of help. It's been ignored. It's on the verge of collapse. If we continue down this path, we will rely on imported seafood and certainly imported shrimp, which is hurting the worst within the seafood industry. And I don't know how familiar you are with this industry, but I'm curious to hear your opinions and what can be done to improve this.
Well, sir, as I mentioned earlier, this coastal elite grew up in a fishing village that when I was young was 500 people, so I'm very attuned to that. And again, on one hand, you're saying you don't like tariffs, on the other,
no, I don't like tariffs on our energy sector. Yeah, we do need tariffs in certain industries. This is one of them that I think would make sense.
And you know, I agree, and I'd be happy to work with you on this. We've worked with the Alaska delegation extensively on what's happening with Russian illegal fishing and illegal or sales to China that's then transshipped back to the U.S. So we'd be happy to work with you on this.
I'd love that. Okay, I'll be in touch with you. Thank you so much, and I yield back.
Thank you. The gentleman yields back. The gentleman from South Carolina, Mr. Timmons, is recognized for 5 minutes.
Thank you, Mr. Chairman. Secretary Besson, thank you for being here.
This is Republican Congressman William Timmons of South Carolina questioning the Treasury Secretary Scott Bessent before the House Financial Services Committee.
Your steady leadership is appreciated on both sides of the aisle. And after an abysmal 4 years, it is encouraging to see thoughtful and serious leadership guiding this discussion once again. And I would like to add a personal note. Both of us proudly call South Carolina home, and my family, like yours, also came to Charleston in the 1600s. I know you understand the economic landscape of South Carolina deeply, and that perspective is invaluable in the position that you hold. Let me start with a question about the textile industry. South Carolina, and especially my district in the upstate, has a long history in textiles. For over 100 years, it was more than just an economic sector. It was part of the cultural and social fabric in our communities. But there was a drastic shift in the 70s and the 80s. Well-intentioned regulations from Washington related to labor and the environment made the U.S. economy no longer competitive. And while I agree with the policies that we should not dump dyes and chemicals into the rivers, and we should not have 120 degrees in factories, and people should only work 40 hours a week, we need to focus on being competitive. And those regulations, all they did was push all of our textile jobs to China, or most of our textile jobs to China. China took advantage of it, and they incentivized and subsidized textile manufacturing, capturing an enormous amount of the market share. Hundreds of thousands of jobs were lost in the South. Recently, you made a comment suggesting we do not need to bring the booming textile industry that once defined the region where we both grew up back. And that statement stirred some concern from some of the textile companies that survived in the district. And I agree with your broader point that we should not return to producing low-quality goods just for the sake of manufacturing in the United States. I do want to ask, do you agree that we should prioritize support for the American textile industry that are still here, and particularly leaders that are in innovation and high-tech manufacturing and people that are producing Berry Amendment products for our warfighters?
Congressman, what I mean and meant was the survivors in this industry, they have done it through innovation, and they will continue to innovate, and they are high-end textile manufacturers. I remember going to China in the 1990s and 2000s and seeing everything that had been outsourced there in the textile industry. Sock City, they would have Sock City, Underwear City, and those are the jobs you and I grew up with. Many people our family, friends involved with. And I think that we, through good tariff policy, we can make sure that these existing businesses can grow and thrive, especially in the high end. And again, anyone who has survived has done it through innovation, hard work.
And that's what I told them. I told them that we still support them, and we are going to make sure that they continue to thrive.
Sir.
Absolutely, absolutely. So I want to turn to the automotive industry, and specifically BMW, which operates its largest plant in the world in Spartanburg, South Carolina. That facility, which opened in 1994, has helped make our state the top auto exporter in the U.S. It employs either directly or through a nearby supply network, indirectly, almost 80,000 of my constituents, almost 1 in 10 of them. And foreign automakers like BMW are continuing to invest heavily in U.S. manufacturing. Incredibly, they have invested an additional $4 billion in the last 3 years, and that investment has real lasting benefits for American workers, exports, and innovation. It is President Trump's promise to the American people to renew the U.S. economy's competitiveness in the global economy, and this is an effort long overdue. My question is this: as President Trump renegotiates our trade relationships with the world, is it fair to say that BMW, the type of investment that BMW has made, a generational investment, is what we're hoping to incentivize?
Yes, Congressman. I regularly see at the Port of Charleston, the BMW X Series sitting there for export. And I think that the president recently met with the heads of the 3 German auto companies and is working toward a solution for more American content and more made in the U.S. rather than just as assemblers. So it would be more jobs in your district.
And that message was heard loud and clear, and they're going to continue to invest. They've been a very good partner, and I'm just excited because interest rates coming down, energy costs going down, regulatory relief, a more fair trade deal. We are going to be the best place to start to grow, to build a business, and I appreciate your leadership in that regard. Thank you, sir. I yield back.
Gentleman yields back. Gentleman who's the vice ranking member of the full committee, Mr. Caston, is recognized for 5 minutes.
Thank you, Mr. Chair. Secretary Bessent, I'm starting.
We're listening to testimony in the House Financial Services Committee by the Secretary of the Treasury, Scott Bessent, who is now being questioned by Democratic Congressman Sean Casten of Illinois, live on Bloomberg.
System earlier this year. As you know well, this is the system that manages over $5 trillion a year of federal payments to taxpayers, payers to Social Security beneficiaries, payers to embedded foreign assets who are overseas and undercover, and it has their personal information and their routing information. This is a purple district. People were nervous. We sent a letter to your office along with 150 colleagues asking 20 questions. Your response that we just received was non-responsive on all 20. Mr. Chairman, I'd like unanimous consent to enter those 2 letters into the record.
Without objection.
I want to get through a lot of those questions right now, Secretary Bessent, and I would ask you to be as brief as you were in your response, but I would very much like a more fulsome answer in writing. In January, the New York Times reported that you pressured David Lebrick out of his role overseeing that after he refused to grant that access to people that Elon Musk had imposed. Can you confirm the accuracy of those reports?
That's incorrect, Mr.
You met with him on January 30th, put him on administrative leave, and he left the day later. Is that accurate?
I did not put him on administrative leave. Administratively, I asked him to I met with him 90 minutes.
So you're denying the New York Times report? Was it your choice?
I am adamantly saying that the New York Times is inaccurate.
Okay, all right, fine. That's yes or no. New York Times is inaccurate. Fine.
He was not placed in administrative leave, and he was subsequently resigned after sending numerous emails.
Sir, I'm just asking for yes or no questions. If you want to be voluminous, please write me a letter. Was it your decision to terminate Mr. Lebrick, or were you pressured by others?
He resigned.
Who made the decision to put him on administrative leave? You or someone else?
Again, sir, he was not put on administrative leave. That is
okay, so you're denying the New York Times. Fair enough. Tom Krause, you a fan of him, who's now playing that role?
Yes.
Okay. You'd mentioned earlier he was in that role. Do you agree that that role includes duties that include managing Treasury's payment system to ensure timely Social Security payments, overseeing auctions for U.S. Treasury bonds, which determine interest rates, and ensuring the U.S. doesn't breach the debt limit? Would you agree that that's all part of the functions of that job that Mr. Rouse is now holding?
No.
No. Shocking. Okay. Does Mr. Krause have any prior experience in government service?
He does not, neither do I.
Does Mr. Kraus have any prior experience in the financial sector, which of course you do?
What's that?
Just, you can answer me, you don't need to, I'm doing this solo, you don't need the people behind you to help you. Does Mr. Kraus have any prior experience in the financial sector?
He had, in the financial sector, yes, he's put together more than.
No. Did he work for a bank? Did he work for a hedge fund? Did he work for a private equity firm?
He worked for a private equity firm.
He's the CEO of a software company.
He's done more than $100 billion of tech deals.
He runs a software company. He's still the CEO of that software company, isn't he?
I'm not sure.
He is. Is it your view that that job that he's holding is a part-time job?
I'm not
managing $5 trillion a year of distributions. That's a part-time job, or does that require full-time?
No, sir. He is not managing $5 trillion a year of distribution. He is doing a tech upgrade and ERP.
That's all that Mr. Lebrick was doing, was a tech upgrade?
Sorry?
Mr. Lebrick, who said, I'm not going to allow people to hack into this system. He was just doing a tech upgrade? Or you've downgraded what that job function is?
Mr. Lebrick was in charge of 1.5 billion payments a year, which 1/3 did not have a task identification.
Sir, come on.
So he had
Come on, we're going to move along. The chairman, notably a moment ago, did not swear you in, so you are not under oath right now. February 4th, in your response to a Senate Democrats letter, you said that Mr. Kraus will only have read-only access. A moment ago, in response to our chair, you said, and I quote, they were only granted read-only access at Treasury. You're not under oath right now. You could be, but you're not. Mr. Gioeli testified under oath in a recent hearing, saying that Mario Alez was given right access to the Treasury payment system. Do you wish to correct your remarks to the chair with the ranking member?
I would say that
no one was given right access.
I never granted anything other than.
But Mario Alez was granted right access.
I never granted anything other than read-only access.
Mr. Alez left the Treasury Department in part after it was discovered that he said normalize Indian hate and I just want a eugenic immigration policy. Do you agree with those sentiments?
I do not at all.
Do you think that someone who has those sentiments should be employed in your department?
That I had a conversation with the vice president. That I admired his grace.
He then went to HHS.
Gentleman's time has expired. Thank the gentleman from Illinois. The gentleman from Indiana is now recognized. Mr. Stutzman for 5 minutes.
Thank you, Mr. Chairman, and Mr. Secretary, thank you for being here. Frankly, I apologize.
This is the voice of Republican Congressman Marlon Stutzman of Indiana, about to begin questioning the Secretary of the Treasury, Scott Bessent, who is before the House Financial Services Committee, heard live here.
With respect to the individuals originally referenced by Ranking Member Waters, who may have had access to certain BFS systems, and in response to Mr. Caston, do you want to add any additional information on that matter?
I would say that is in litigation, and I never authorized access.
Thank you. Well, I just want to say thank you for your service and for your willingness to come serve in Washington, D.C. at a critical time, and the fact that you heeded President Trump's call, and it's refreshing, honestly. We see a lot of ups and downs, things are, happening around the world, but here at home, there's a reset that's happening, and that does create some volatility. But I'll tell you what, there's a lot of good news that I think the other side is missing. And I find it ironic that this chart was handed out earlier. And of course, it tries to show that all the blame is on the Republican presidents over the past century or so. But the one that really caught
Congressman, if I may interrupt, as a former finance professor, that chart we get an F.
Well, I agree, and it's interesting that this big drop off right here after President Clinton. I live in one of the heaviest manufacturing districts in the country, and I know that businesses don't turn on a dime that quickly, but that was because of different trade policies. Something happened during the President Clinton era that caused a lot of jobs to leave. And that's what President Trump and you are trying to fix. Is that correct?
I think that thing was called NAFTA, sir.
Exactly. Well, thank you for doing that, because we saw jobs growing up in Northeast Indiana in the auto industry, and agriculture, manufacturing just continue to have this slow decline. And manufacturing is critical to a nation. and manufacturing has built America. And we've seen jobs leave because of bad policies over years. But because of President Trump and because of you, sir, we're now seeing headlines that say Rolls-Royce planning to shift production to the United States to avoid Trump's tariffs. We see headlines saying Johnson & Johnson to invest over $55 billion in U.S. in the next 4 years. Even in my district, GM has announced that they're increasing truck production. I know coming from a manufacturing family that we're seeing opportunities. Is it going to happen overnight? Absolutely not. But it's at least giving us the opportunity to look forward and say, there's an opportunity because you all are resetting the table to look out for America first. And so I want to say thank you. And, if you don't, and if I've heard you say this before, that President Trump has tasked you with reducing debt and deficits as well as keeping the economy strong, that's a huge task, but it's one that has to happen. And I appreciate what you've been doing because the debt crisis would just flat out limit us to any sort of recovery. It'd be very difficult. I want to ask you real quick about the Federal Reserve's dual mandate. Generally speaking, should the Federal Reserve focus more on fighting inflation or providing maximum employment? And what should the Fed focus on if the economy enters stagflation?
Sir, I would just comment on monetary policy in general rather than the Federal Reserve. I think the two are inexorably linked. And as we saw during the terrible inflation during the Biden years, that employment picked up, but that was a slingshot effect as we came into post-COVID recovery that financed by debt-fueled government spending. And we are trying to end that. So the Federal Reserve should focus on both, and it's at different times. But look, keeping inflation down, President Trump won because of, I believe, because real wages for working Americans dropped.
No, that's absolutely right. And we saw the cost of living go up. The last 4 years have been the hardest on Americans due to the former administration's policies. And I know that there's a huge recovery and people are still trying to recover and are hopeful and optimistic. And my time's about to expire, but I just wish you the best and I want to say thank you. And working together here in this committee, there's plenty of places to work together and try to get us back on track rather than pointing fingers. So,
gentleman's time has expired. We now recognize the gentlewoman from Massachusetts, Ms. Presley, for 5 minutes.
Thank you. Secretary Bessler, you have...
We're listening in live to the House Financial Services Committee, where the Treasury Secretary, Scott Bessent, is facing questions from lawmakers, now beginning. Democratic Congresswoman Ayanna Pressley of Massachusetts, heard live on Bloomberg.
Wreaking havoc on our economy. Rather than delivering stability for our country, this Trump tariff tantrum has been inconsistent, counterproductive, and disconnected from reality. In my district, the Massachusetts 7th, I'm hearing it from everyone. Small business owners are reeling from the unpredictable on-again, off-again tariffs. They're holding back on expansion, delaying hiring, and bracing for the impact. Local and state officials are telling me about the effect tariffs will have on our state budget. Simultaneously, Massachusetts will see energy bills increase while revenue from tourism will decrease. But I want to focus on the constituent outreach that I've received from everyday families who are just fighting to make ends meet. Yes or no? Mr. Secretary, do you know what a car seat is?
I have 2 children, yes.
I figured as much. It's correct, you and your husband have 2 children. So I'm sure you know that car seats are absolutely essential for families when traveling with babies and toddlers to school, to worship, to doctor's appointments, just everyday living. But not only are car seats essential, they are the law of the land. It's the law of the land in 50 states. So there's no getting around that. Mr. Secretary, what's your estimate of how many babies are born in the United States each year?
I would guess 2 to 3 million.
Well, while the number fluctuates, there have consistently been more than 3.5 million babies born in the United States. That means millions of families in this country are doing what? buying a car seat because it's essential and it is the law of the land in all 50 states. But now that cost is going up because Trump has announced up to 145% tariffs on Chinese imported products. Approximately 9 out of every 10 car seats in the US come from China. That's a steep cost. Steep cost hike for families all over the country. The price is up in Republican districts and in Democratic districts. And it's not just the car seats that are impacted. We're talking about strollers, cribs, high chairs. No family is exempt from the harm of these Trump tariffs on essential baby products. But don't just take my word for it. Mr. Chair, I would like to enter into the record a Yahoo Finance article from May 2025 entitled First Year Baby Expenses Already Top $20,000 and Tariffs Are Adding to the Bill as China Dominates Key Imports.
Without objection.
Look, I support improving manufacturing in America, but that is not going into effect overnight like these tariffs are. There needs to be an exemption to help America's families. Trump has used his power for tariff exemptions on thermoplastics, semiconductors, but what about baby products? Mr. Secretary, do you support an exemption to tariffs on items that parents need to care for their kids? Yes or no?
Congressman, what you're referring to are...
Yes or no?
What you're referring to are...
I'm reclaiming my time because I don't want you to filibuster and give me some macroeconomic answer. Families at home are hurting and so just give me a direct answer.
I am going to agree with you that
So yes, you do support an exemption on tariffs for products that are essential for families for their babies.
Exemptions on E4 items, which...
I'm sorry, I have to reclaim my time. I'm reclaiming my time. I am, Mr. Chair, I am reclaiming my time. Give me my time back. I'm claiming my time. I just want a simple yes or no. Do you support an exemption to tariffs on items that parents need to care for their kids? Because you all claim you're pro-family. I cannot hear the words you say because I see the things that you do every day. So clear it up. Yes or no? Do you support an exemption to tariffs on items that parents need to care for their babies?
It is under consideration.
Right. Good. I don't know what's stopping an exemption from going into effect today, so do it now. And Donald Trump's America's price is not yesterday's price, is not today's price. Costs are going up. Everyone is suffering, especially our families with young children. Mr. Secretary, I'm making an appeal to you on behalf of the people of this country. Please tell occupant Trump to reverse course and stop hurting America's families. I yield back.
Gentlewoman yields back. Gentleman from Pennsylvania, our chair of our Oversight and Investigation Subcommittee, Mr. Muser, recognized for 5 minutes.
Mr. Secretary, great to be with you. Thank you. Boy, oh boy, I sure wish we had colleagues that were upset about the Biden 20% inflation.
This is Republican Congressman Dan Muser of Pennsylvania, beginning his questioning of Secretary of the Treasury Scott Bessent in the House Financial Services Committee.
Throughout my district, thousands of dollars. I wish we would have heard a peep about that, and yet we have just angry voices over the potentiality of bringing manufacturing back to the United States that, in fact, hasn't even got into effect yet. It's nuts. Mr. Secretary, the ongoing litigation response to the Democrats' questions about the Treasury Doge team, is it true that they can find all the information, find all the available information there?
Yes, sir.
Okay, thank you. Also, regarding the beneficial ownership rule, which was a disaster for my small businesses, I mean, all of them, 100% complained about it. The original intent of the Corporate Transparency Act was to root out bad actors. The previous administration, however, turned it into a massive data collection with over 50 questions. Originally, there were 4 that outraged small business, accountants, attorneys, anybody who had anything to do with it. In fact, only 20% of the small businesses were even able to comply by the January 1st deadline. And meanwhile, they were threatened with fines up to $500 per day and up to $10,000, small businesses. They were beside themselves. You listened to the small businesses and did something immediately to correct course, exempting U.S. companies from reporting. And my small businesses throughout my district, throughout Pennsylvania, applaud you for eliminating a needless bureaucratic reporting regime. So thank you.
And Congressman, I'm just sorry that so many of them had to waste their hard-earned dollars, either complying or preparing to comply.
And losing sleep and everything else, and some even going out of business because they found it preposterous. Thank you. Let's talk about removing the ideological, subjective, even capricious regulators how will you, under the Biden administration, bank supervisors focused more on ideological concerns and less on material, bright line financial rules versus the risks? How will you work with bank regulators to refocus supervision on bright lines rules rather than issue unrelated to safety and soundness?
Again, Congressman, very important point. We could see that we had under the previous administration, we had 3 of the largest bank failures in U.S. history. 2 weeks before that, the Financial Stability Oversight Council published a report that said that climate was the biggest threat to the financial system, not the deposit volatility, not over-leveraged bond portfolios. So we are promoting common sense, back to basics.
Yes, thank you. Okay. The efforts related to the removal of reputational risk as a basis of supervisory criticism, can you comment on that?
Yes, sir. Many people, many individuals, many organizations were debanked because of their political beliefs, and regulators used that as a litmus test, and that it is a very capricious category in bank regulation. So we have moved to remove that as a criteria. We believe that financial ratios are much more important than whether you are a Democrat, a Republican, or an independent.
Thank you. Yes, well put, and appreciate the fact that you see things that way, as should be seen. Capital requirements, Basel III Endgame, of course, the GSIB surcharge and other proposed capital rules might put U.S. banks at an international disadvantage. What do you believe, if you got an idea of the right level for capital requirements?
So we are examining that now, and we will weigh in heavily at the BIS and the other rulemaking entities. But again, this one size fits all. And I believe one of the reasons we've seen the stagnation in many other countries is the regulatory, the framework, the very tight regulatory framework that they put around their regulated financial institutions.
Thank you. I'm almost out of time. I'll yield back. Thank you very much, Mr. Secretary.
Thank you.
I thank the gentleman. The gentleman from New York, 5 minutes.
Thank you, Mr. Chair. During so-called Liberation Day,
and now Democratic Congressman Richie Torres of New York has his chance to question Scott Bessent, the Treasury Secretary, in the House Financial Services Committee. Heard live on Bloomberg.
The United States runs a trade surplus, not a trade deficit. He imposed tariffs on products that cannot be produced domestically, which means a higher cost for American consumers without any benefit to American manufacturers. He imposed tariffs on impoverished nations like Lesotho, which cannot afford to buy as much from us as we buy from them. If President Joe Biden had put in place these absurd tariffs, every single Republican, without exception, would have condemned his trade policy as the height of incompetence. And you, Mr. Bessent, would have joined that chorus of criticism. There's no doubt in my mind. But swap out Biden's name for Trump's, and suddenly the moral outrage from Republicans vanishes like magic. I have a simple yes or no question. Do you think excessive taxation undermines the competitiveness of American manufacturing?
Yes, sir.
Now, the Trump tariff regime is a breeding ground for the excessive taxation of American manufacturing. Consider as an example Intel's manufacturing of CPUs. Intel sources foreign components, which is subject to the first layer of taxation. It then manufactures the CPUs in the United States before exporting it to China, which will face a second layer of taxation. And finally, China will export the CPU back to the United States, where it will face a third layer of taxation. Taxation upon taxation upon taxation of American manufacturing goods. Do you think that kind of compounding taxation of American manufacturing goods like Intel CPU will strengthen or weaken American manufacturing?
Sir, I just want to be clear. You're saying that taxes raise costs.
I'm sorry?
Sir, you're saying that taxes raise costs.
Taxing the intermediate goods that go into a manufactured product raise costs, yes.
You're saying that taxes are inflationary.
Taxes are inflation, yes.
Good, then we should cut taxes.
In the context of tariffs, yes.
Then we should cut taxes and you should join the...
Can you answer my question about the tariffs?
In the tax bill.
Can you answer my questions about the tariffs?
I'm not sure I understand.
CPU's Intel would face Intel CPU would face 3 levels of taxation: the taxes on the foreign components, the U.S. taxes, and the Chinese taxes or the Chinese tariffs. Do you think that kind of compounded taxation hinders or helps American manufacturing?
I think the strategic American manufacturer is very important, like Intel, and I think we have to bring that back to the U.S.
Do you think taxing intermediate goods that go inside American manufactured products helps or hinders manufacturing?
I believe that, as the Intel example you give, we have to bring these strategic industries back to the U.S.
We're not going to bring every component. A Boeing aircraft 747 has 6 million components. There is no universe in which we're going to manufacture all 6 million components in the United States. And so if you impose a tax on those foreign components, you are hindering the manufacturing of Boeing 747 here in the United States. Do you even acknowledge that?
I acknowledge that the supply chains, are wide, but we've also, for the automakers, we have given an exemption.
I'm not asking about the auto. Automakers, I'm asking about Boeing aircraft. Let me move on. Critical minerals are essential to the military defense of the United States. China controls almost all of the world's rare earth mining and almost all of the world's critical mineral processing and refining. The Trump administration has chosen to wage a total trade war with China without first building a critical mineral supply chain here at home. Just like it would be foolish to enter a car race without enough fuel in the tank, or enter a weightlifting competition without sufficient strength to lift the weights. It seems equally foolish to wage an all-out trade war on China without a domestic critical mineral supply chain. Breaking China's strongest chokehold over the United States, the CCP's chokehold on critical minerals and rare earth elements, is a precondition for winning the trade war against China. Do you agree with that?
I believe that we have to bring the rare earth, as you correctly said, processing back, or not even back to the U.S. We have
It's not only processing, it's rare earth mining as well. And it's critical mineral processing and refining.
Strategic minerals.
And the weaponization of critical minerals against the United States is the opposite of making America safe again.
Rare earths are not that rare. Processing is rare.
The mining is rare too. We have a insufficient mining industry here in the United States, and you know that.
Good, then I'll hope you'll join us in the deregulation of many of these onerous mining requirements.
I think my time has expired.
Appreciate the gentleman from New York. The gentlewoman from California, Ms. Kim, is recognized for 5 minutes.
Thank you, Chairman Hill and Ranking Member Waters, for holding this.
And now it's the turn of
Secretary
Republican
Besson, good to see you,
Congresswoman
and
Young
thank you
Kim
so
of
much for
California,
coming.
member of the House
Southern
Financial Services
California,
Committee,
where
where the
I'm
Treasury
from,
Secretary
district
Scott
that I
Bessent is currently
represent, serves
testifying.
as the
Heard live
primary
on
gateway
Bloomberg.
to Pacific Rim, and Asian goods into the United States come through the ports of LA and Long Beach. But we are already starting to see a drop in volume as the ports of LA and Long Beach are expected to see 35% to 30% drop when compared to a year ago. Cargo volume is one of the largest economic drivers in the region, and long-term drop will not just impact families, at the grocery stores and small businesses' bottom line, but also result in truckers and dock workers losing their jobs. So, Secretary Besson, I would like to ask, how can you ensure that our tariff policy will not unintentionally harm American small businesses and workers in the long term?
Well, Congresswoman, we believe over the long term that it will drive growth in the economy. And as I've said many times, it is a mistake to look at trade in isolation. The Trump economic policy is a three-legged stool: trade, taxes, and deregulation. And we believe that the sum of the parts, that the whole is greater than the parts. And as we complete each one of those, that the U.S. will see substantial economic growth.
Thank you. You know, I know that a lot of my constituents share these concerns that we raised. So I'd like to continue this discussion on this specific topic with you moving forward, because I'm concerned that these long-scale tariffs, if they continue in the long term, then American working families and small businesses will suffer under price hikes and a lack of certainty. But I want to shift gears and discuss the Financial Stability Oversight Council, FSOC. Under the previous administration, Secretary Yellen rescinded the non-bank systematically important financial institution and replaced it with a new framework for assessing the financial risk. And this new framework overlooks the importance of prioritizing an activity-based standard and a cost-benefit analysis. So Secretary Besson, does FSOC intend to reassess the 2023 guidance so that it is more closely aligned with the thoughtful process that was created in 2019?
Congresswoman, that is on our agenda.
Thank you. You know, as you finalize that decision, I want to emphasize that my support for a return to an activity-based standard that more appropriately addresses the risk of non-banks. Thank you.
Treasury would be happy to work with your team on that.
Thank you. And finally, I'd like to urge you to continue your support for CDFI. CDFI fund programs are statutory, as you know, and it has been critical in promoting the local economy in Orange County. So do you still agree that the CDFI fund has a critical role to play in fostering economic opportunity? I think I know the answer because you stated very clearly in public statements.
We believe that if CDFIs follow their statutory obligations and do not digress into more ideological boundaries, that they can be important institutions.
Thank you. As you know, last week, I attended the financial literacy roundtable that your team put together, and thank you so much for inviting me.
I think I just missed you.
But your team was very well represented, and again, I want to thank you so much because as a co-chair of the Financial Literacy and Wealth Creation Caucus, events like that, bringing the stakeholders together and having a meaningful dialogue and conversation, I think is critically important, and we need to continue that. So can you talk about how you can continue to advance financial literacy initiatives now that we are past the Financial Literacy Month? I mean, I was able to take the leadership and pass the bill that proclaims month of April as the Financial Literacy Month, and I hope that we can continue to work in this space together.
As you should know, that it is a strong core belief of mine that financial literacy is the only path to economic independence and well-being. So the more Americans who can be educated, and I think we should probably go state to state and encourage each state to put in financial literacy standards for their students.
Gentlewoman's time has expired. The gentlewoman from Texas, Ms. Garcia, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to the Secretary for being with us today.
This is Democratic Congresswoman Sylvia Garcia of Texas, getting her turn to question the Treasury Secretary Scott Bessent as he speaks before the House Financial Services Committee, heard live on Bloomberg TV and radio.
Pardon me?
Your testimony reads right at the very top, embargoed until delivery, which means that we didn't follow the usual practice of this committee of getting the testimony 24 hours in advance so that committee members can review it and prepare for questions. Yours was posted at 10:01. The committee was at 10. Well, it looks like you need.
My staff is just telling me that it's standard practice.
It's your standard practice? It's not our standard practice. As a committee.
I'm told that it was standard practice.
Okay, you were told by whom, sir?
So my comms team and legislative affairs team working with the committee.
Well, Mr. Chairman, I think for the record, I think you should clarify to the gentleman that that is not our standard. And I know that at least I didn't know anything about this until I got it here. And I don't think our committee staff on the Democratic side was notified that we would be getting all your testimony late. I just wondered, why you had made that request, and clearly at the top, embargoed until delivery.
Well, embargo to delivery, I think that was mostly meant for the press.
We're not press, sir. We're the members of Congress that have oversight. So, Mr. Chairman, I would hope that you not condone this kind of late submission. It just doesn't help. Frankly, for some of the atmosphere that's created when we all just sit down and we still don't have your testimony, well then we just sort of don't feel really good about that. It's not our custom.
Congresswoman, I appreciate the importance that you put on my statement.
Well, thank you. Notice is important, sir. Do you know what the poverty rate is in our country?
I believe that the poverty level is a fixed number.
No, do you know the poverty rate in this country?
I believe it is in the teens.
In the teens, okay. Well, it's about a little over 11%. It just strikes me that most of all of your testimony is always about the tax cuts and cutting costs, and it's always about tax cuts, and it's always about the rich. But nothing is ever said about poor, other than you suggesting that you worked yourself.
No, ma'am. No tax on tips, no tax on Social Security, no tax on overtime.
Sir, I read your testimony. That's not anywhere in here. That is not in here.
Deductibility.
I am referring to your testimony and what I've listened to. I said right up front, I can see you and I can hear you. You've not said one thing about what we're doing to help the poor. In fact, even when we were talking about the car seats, that impacts poor people more than anyone else, because not only can they usually not even afford a car seat and have to go to a garage sale to find one, now it's going to be even higher. Your president is suggesting that he wants to give a $5,000 bonus to women to have babies, and then what? Just leave them out on the cold alone? No car seat, no food, no Medicaid, no
Congresswoman, I can tell you the worst.
And I'm asking you right now, sir.
The worst thing for working families will be the expiration of the 2017
as Secretary of Treasury, it's not just about
Act.
the inflation rate. It's not just about the GDP. It's also about making sure that we keep the poverty rate in this country low. There are people who are living in poverty that never have lived in poverty before. You also failed to say here, you say unemployment remains low. I mean, that somebody should have read unemployment went up. Because it did.
Under the Biden administration,
and the growth administration, we're not talking about Biden, sir. We're talking about your testimony here today about the current president and his plans. Because I can tell you, I'm from Houston. I'm concerned too about some of the terrorism on energy. We have done a lot to increase trade in Houston, construction, everything after the pandemic. And all things were growing. Everything has been growing. But now that the Trump terrorists have surfaced, it is threatening Houston's economy. I represent the area where almost the entire ship channel is in. The petrochemical companies all are in my district. The port is in my district. Everybody is trying to figure out what the hell we're going to do.
Mr. Chairman.
Ranking member.
I ask unanimous consent to enter into the record the opinion and order by the United States District Court in the Southern District of New York in the matter of New York versus Donald Trump that directly contradicts several responses the Secretary gave to me about DOJ's access to Treasury payment system.
Without objection. I want to thank our witness today. We appreciate Secretary Bessent's testimony. Without objection, all members will have 5 legislative days to submit additional written questions for the witness to the chair. The questions will be forwarded to our witness for his response. Secretary Bessent, please respond no later than June 2nd, 2025. This hearing is adjourned.
And that does it. The chairman of the House Financial Services Committee, Congressman French Hill of Arkansas, gaveling out what was about 3 hours of testimony from the Treasury Secretary, Scott Bessent, before the committee, in which he fielded questions from tariffs and negotiations taking place this week in Switzerland with China, or this weekend, rather, to the ex-state, and questions around the debt and deficit. We'll have a full recap of that for you in just a moment, as he also weighed in on Fed policy, saying the Fed should focus on both price and employment goals, with just an hour or so out here from the Federal Reserve's latest rate decision. So interesting timing there. We're going to get to all of that here on Bloomberg TV and radio. This is Balance of Power. I'm Kaylee Lyons in Washington, and also in Washington is Amy Morris, who has a check on how the markets are set up ahead of that Fed decision. Hey, Amy.
All right, thank you, Kaylee. Wall Street investors have been hoping for a de-escalation in the U.S.-China tariff standoff. That drove stocks higher despite bets that the Fed is expected to wait and see, maintaining that stance until there's more clarity on the impacts of President Trump's trade policies. We do check markets for you all day long here at Bloomberg. The S&P 500 is up 0.4%. NASDAQ is flat. The Dow is up about 1%. The 10-year Treasury yield at 4.28%, and the 2-year yield at 3.79%. Walt Disney reporting fiscal second quarter results, beating Wall Street estimates, raising its outlook for the full year, citing strong performances from theme parks and streaming television. The company expects a modest increase in Disney Plus subscribers in the third quarter. And Disney announced plans for a theme park in the Middle East, the very first one they've opened, a resort property in Abu Dhabi. Shares of Disney now 11% higher. Uber shares are down 2% after that company reported weaker than expected quarterly gross bookings of $42.8 billion, citing lower U.S. inbound travel and a strengthening dollar. The company's U.S. rideshare business, which accounts for more than half of its profitability, was affected by decreased gross bookings per trip, partly because of fewer tourists coming into the U.S. And once again, green on the screen. S&P 500 up 0.4%. NASDAQ still kind of flat, but on the upside. And the Dow is up about 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Balance of Power now with Kaylee Lyons.
All right, Amy Morris with a check on the markets on this Fed day. Thank you so much. We're just about 54 minutes away from that rate decision, which of course is expected to be no change in rates at all. Chairman Powell and company expected to leave them unchanged, probably talk about the flexibility they have to continue to do so and watch as the data comes in, as they consider the policies coming from the Trump administration, inclusive, of course, of tariffs. This was a subject that the Treasury Secretary, Scott Bessent, just got a lot of questions about in his testimony before the House Financial Services Committee, of course, his second day in a row on Capitol Hill this week, answering questions about this, what it would do to costs for consumers, baby products, for example, but also the state of negotiations with different countries. Remembering we heard from the Secretary in his testimony yesterday that negotiations had not yet, in fact, begun with China in particular, which currently has 125% retaliatory tariff on all U.S. goods because the U.S. has 145% tariff on Chinese goods. But those conversations will begin shortly. We heard about it from the Treasury Secretary himself, previewing what's to come in Switzerland this evening.
I will be going to Switzerland, and the negotiations will begin on Saturday. The trade negotiations will be led by myself and Ambassador Jameson Greer,
and
USTR.
And what about Pete Navarro?
Sorry?
Peter Navarro.
He will not be joining us in Geneva.
So the Treasury Secretary and the U.S. Trade Representative, not trade advisor at the White House, Peter Navarro, planning for talks in Switzerland this weekend. Not this evening, as I said a moment ago, but we want to get more on that and the rest of the Treasury Secretary's testimony and turn now to Bloomberg's Tyler Kendall, Washington correspondent, who is live outside the committee room on Capitol Hill. Tyler, a lot went down in the last few hours.
Yeah, Kaylee, and in fact, we couldn't have timed this more perfectly because the Treasury Secretary is actually walking out
right now. Mr. Bassett, Mr. Secretary, will you lower Chinese tariffs this weekend during negotiations? All right, well, that was one of our tries, one of our big leading questions here as we wait to see what potentially could come out of those negotiations as they do head to Geneva over the weekend. As you mentioned and played that shot, Peter Navarro not expected to be in those talks. When it comes, though, broadly speaking about these trade negotiations, the Treasury Secretary did say that we could still expect to see some sort of principle, agreements in principle, as he called them, as soon as this week, and that they would later paper those deals over in the months ahead to make them fully fledged agreements. We have yet to get any update from the White House on when those potentially could be coming. Sticking with China, though, it was interesting because he said that the Treasury was working with legislators on outbound investment rules for China that would make it clear what's allowed in and what's not. And he said it would basically amount to a red light, green light system to be used as a national security tool in order to restrict China from allegedly exploiting American capital. Quickly, I would also like to add, Kaylee, that when asked directly, when it came from China to actually Russia, when asked directly if he thought that Vladimir Putin was a war criminal, he answered in the affirmative yes, but that ultimately you do need to negotiate with both sides. That is the nature of diplomacy in order to get a deal done. I will also add, of course, we can't talk about this administration's economic policies without also pointing to the tax cuts and the reconciliation package. Treasury Secretary Besson, perhaps one of his more contentious exchanges with one Democratic congressman, did say that he thinks the deficit to GDP ratio will stabilize and go down over time if this reconciliation package passes. But when pressed by that congressman, he did say that long-term debt will likely go up if the bill passes, but if GDP goes up faster, then it wouldn't really matter. He did affirm that the U.S. will always meet its debt obligations and did not give us an update on a potential ex-state, instead saying that it's a moving target. Of course, as you well know, we have been watching that very closely because that's considered to be that sort of hard deadline when it comes to things on when these lawmakers are going to have to pass that reconciliation package in order to lift the debt ceiling.
And Tyler, just quickly on that, Secretary Besson will also be partaking in another one of the so-called Big Six meetings on reconciliation today. Do we expect today to be a day of real progress?
At this point, we haven't really seen much progress, and I can tell you behind me, you actually might be able to see it. There is a dual hearing going on in the Energy and Commerce Committee, and they are trying to figure out exactly how to shift through the debate when it comes to potentially Medicaid cuts. That is one of the biggest litmus tests here, if you will, that Republicans really do have to find. We even saw that House Speaker Mike Johnson recently said that the $880 billion target over 10 years is likely very ambitious. As of now, Kaylee, we're tracking that they're negotiating potentially work requirements, but how expansive that would be remains to be seen.
All right, Bloomberg's Tyler Kendall live on Capitol Hill and trying her best to get one more answer out of the Treasury Secretary after his hours of testimony. Thank you so much. Here live on Bloomberg TV and radio. And joining us now also from Capitol Hill, but instead of the committee hearing room from the rotunda, is Republican Congressman Greg Murphy of North Carolina, who happens to be a member of the House Ways and Means Committee, which is also meeting on reconciliation today. Congressman, you're very kind to step out for us, as I know there were some important conversations happening between you and your colleagues on the committee earlier. Can you give us any insight as to whether or not tangible progress has been made, particularly on the issue of the SALT cap?
Yeah, well, Chairman Smith has sworn us to secrecy, but I will tell you that we've been making definite progress really over the last 3 or 4 weeks, if not several months, on trying to get a solid package. Obviously, SALT is very concerning to some of the members, where you have California and New York, which have insane taxes on their citizens. We're trying to put something into a package that will help alleviate some of the tax burden that they have. That said, Kaylee, the bottom line is we have to worry about our debt. And as the Secretary said, our debt to GDP ratio really right now is killing us. So when we bring all these discussions together, we have to worry about one singular thing. It is the singular focus on our debt. And we're trying to have pro-growth tax policies to grow that GDP, to make sure that it is higher than our debt ratio. And so we try to grow ourselves really into a place of stability.
Well, Congressman, I understand the chairman may not want you to reveal too many details, but he in fact spoke with my colleague Julie Fine yesterday and suggested that when it comes to SALT particularly, everyone is going to end up unhappy with whatever compromise is made. With the way things are tracking now in conversation, do you expect there will be more unhappiness from some of those blue state SALT caucus members, or those who don't think the SALT cap should be materially lifted?
Well, I think it is a tension. It is a battle. We're worrying about our deficit, but those members in California, New York, the high tax states really do want some relief. Yeah, everybody's probably going to be proportionally unhappy as we move forward with this, but that's what would happen with all the tax packages. There are going to be some winners and some losers, but they're all going to be winners and losers in some regard.
And Congressman, as you were just alluding to the Treasury Secretary's testimony around the debt to GDP ratio, specifically, which he said is something that even the former Treasury Secretary Janet Yellen watched rather than the sheer level of the deficit. When he was pushed under questioning if that deficit number itself was likely to go higher, he did say yes. And I wonder if that is an acceptable outcome to you as a Republican.
Well, we want the bottom line is we want the American economy to be able to, the American government to be able to repay its debts. That's the bottom line. It really doesn't matter specifically on numbers. The real crux of the matter is, can we pay back our debts? And if we're growing our economy greater than we're producing a deficit, that is the goal. That is the goal itself. So real numbers themselves are great, but you really look at ratios as to really what the most important factor is.
Well, and of course, spending has to factor into this as well, specifically where spending cuts have been identified or will be identified. And Congressman, I don't have to tell you, as we just heard from my colleague Tyler, Medicaid is very much in question in this argument. This is something that the Senate Minority Leader Chuck Schumer of New York spoke to us about here on Bloomberg yesterday. And this is what he said about Medicaid cuts in particular.
We asked them, give us specific examples of waste when they're cutting Medicaid. And they failed to come up with them or have one anecdotal thing that can't even be proven. We know that they want to slash Medicaid, not because of waste, but for one reason, and that is to give tax breaks to the wealthiest people in this country. God bless the people who made a lot of money, but they don't need a tax break, certainly when you're cutting Medicaid, which is going to cause huge layoffs, decline in health care, and closure of hospitals and nursing homes.
And of course, sir, you are not just a sitting congressman, you are also a medical doctor. And it's with that in mind that I ask you about this, considering we got new figures from the Congressional Budget Office in response to a question asked by Democrats about some of the various proposals that could be put forward here. They estimated, the CBO estimated that capping federal spending in states that have expanded Medicaid, which hasn't been ruled out by the speaker, would lead to 3.3 million people being booted off their coverage. Is that something you would support?
Well, first of all, Chuck Schumer's being false. He's being absolutely wrong in what he's stating. I'm a practicing physician. I can give you many examples of waste and fraud that's going on in the Medicaid system. So he doesn't know what he's talking about. Second of all, Republicans are destined, and this is what our plan is, still to raise Medicaid probably by about close to 25% over the next decade. We have to get to a system, and if you're going to pick one word for this administration, it's called accountability. And any business person, anybody who's looking at this program understands you can't run a business and you can't run a government without accountability. This Medicaid system has been a system that has been abused, used, fixed, and taken advantage of in so many different quarters. And it is okay. It is absolutely the right thing to do to look at this system and make sure that it works for the people that is intended to work for, those who are eligible for Medicaid. So Chuck Schumer, shouting out those nonsense lies is really not helping the situation. Good Lord, I've been a physician for 35 years, and I've taken care of really the most desperate of individuals. The last thing I want to do is not take care of individuals, but we have to be able to pay for it at the end of the day.
Well, and so to kind of come back to my original question, Congressman, if there are indeed millions of people who are booted from Medicaid rolls as a result of this legislation, is that an acceptable outcome?
So if you look at what's happened with the expansion population, we had people that left being insured by companies to go be insured by the federal government. If it means getting them back on insurance by companies and getting them off the federal dole, that's not losing health care, that's taking it off the federal books. But as far as people being kicked off health care, et cetera, those are scare tactics. We're literally trying to save a program for those who are eligible for it while trying to take the benefits truly who don't deserve them.
All right, Congressman, we appreciate your time. As always, Congressman and Dr. Greg Murphy of North Carolina joining us here on Balance of Power on Bloomberg TV and radio as we are live in Washington paying attention to the reconciliation debate on Capitol Hill, a Federal Reserve rate decision that is coming just over 40 minutes from now, of course, expected to be no change in rates, but also what is happening in geopolitics after we have seen some serious escalation between nuclear powers India and Pakistan in recent days. Of course, in the aftermath of an attack on Kashmir back in April, India then striking into Pakistan yesterday, saying that it was only targeting non-civilian targets. Pakistan disputing that, and Pakistan's premier actually, in fact, just within the last 30 minutes or so, has said India must face the consequences of those strikes. So we want to get the latest on this situation and turn to Courtney McBride, Bloomberg national security reporter, who's here with me in our Washington, D.C. studio. So Courtney, obviously the tensions between India and Pakistan, nothing necessarily new here, but we haven't seen this kind of military activity in arguably over 25 years. Is this likely to escalate further?
Well, it's really anyone's guess. There's certainly some escalatory rhetoric coming from both sides, but it really remains to be seen. Pakistan has vowed to retaliate at a time, place, and manner of its choosing. But, you know, we have been here before. In 2019, they came pretty close, it seemed, to all-out war. There was also a shoot down, a capturing of an Indian pilot by Pakistan. Ultimately, they did step back from the brink, and that's certainly the hope this time as well.
What role does the U.S. play in trying to pull everyone back from the brink here? Do they have any role to play in this particular instance?
Well, certainly the U.S. has relationships with both countries. Secretary of State Marco Rubio, in his capacity as acting national security advisor, did speak with both of his counterparts in that acting role and urge India and Pakistan to talk directly and to work to diffuse the situation.
Yeah, now National Security Advisor and Secretary of State Marco Rubio, in addition to everything else he currently has to juggle. This also comes, Courtney, after J.D. Vance just spent several days in India. His visit was primarily focused on trade and trying to reach a trade deal, but it did happen in the aftermath of this attack back in April that, of course, originated this current bout of tensions. Do we have a sense of what the Vice President and Modi talked about when it comes to Pakistan and how it might be shaping the way in which this is all playing out?
I mean, our understanding, you know, obviously any bilateral visit and conversation has a variety of components, but that, as you said, that visit was much more focused on the economic relationship between the two countries. You know, we do have some reporting today on some of the challenges to India's rise economically that are posed just by this ongoing tension with its neighbor. There's a question of instability that certainly can play a role.
Well, especially considering these are nuclear armed countries that we're talking about. No one anticipates, Courtney, that this would ever escalate to a level where the use of those weapons are actually in question, right?
Correct. But, you know, that is an added complication and something that has to be taken into consideration anytime these two neighbors are at odds.
All right, Courtney McBride, who covers national security for us here at Bloomberg. Thank you so much for joining me. As always, again, we're juggling a lot of stories here on Balance of Power today, from what's happening abroad, how the U.S. is playing a role, to what's happening here at home, and conversations on Capitol Hill, also conversations with our trading partners about our economic relationships. And all of that could factor in ultimately to the health of the U.S. economy and what happens going forward with both growth and inflation. Having just heard from the Treasury Secretary, Scott Bessent, testifying before the House Financial Services Committee, saying that the Fed should be focusing on both sides of its dual mandate, prices and its employment goals. The Treasury Secretary saying the two are inexorably linked. And of course, that's what the Fed has to consider as it gets ready to send this rate decision down about 38 minutes from now. So for more on this, we turn to Liz Pancotti, joining me here on Bloomberg TV and Radio. She's Managing Director of Policy and Advocacy at the Groundwork Collaborative. Liz, welcome back to Bloomberg as we consider not just the decision itself, because I think we know that's not going to be where the news is if they don't do anything with rates as expected, but the press conference we're going to get from the chairman shortly thereafter. How hard is this line going to be to walk for Chairman Powell, who is under pressure from the president to cut rates and have to explain to the journalists who are going to question him and to the American people why they are or are not ready to think about doing that yet?
I think Jay Powell has become somewhat of a tightrope walker acrobat over the last really few years, but particularly in the last few months. And so I suspect we'll see him show those same attributes. I think what's really going to be notable in this week's FOMC kind of sense making is that last FOMC meeting, we saw them really just go up right to the line of hinting at stagflation, of slow growth, increasing unemployment, and increasing prices. And nothing since 6 weeks ago has gotten really better. We've gotten new data out showing really slow growth. We've gotten a jobs report that was a little bit hard to make sense of, but certainly we are seeing weakening in the labor market. And we got an inflation print that still shows extremely sticky prices, and combined that with the kind of policy outlook with a trade war, or really many trade wars all at the same time, threatening both the labor market and prices and ultimately growth. I think we will see the Fed sort of hint even more at stagflation this afternoon.
Well, if the hint is going to be stagflation, knowing that in theory monetary policy would step in if there were signs of an outright recession, Liz, when do you expect those signs to materialize? And knowing that the Fed wants to wait to have hard data in hand, isn't just looking at the soft data, can they actually act in a timely enough manner to avert a recession in its entirety, or can they only act to bring us out of one if it occurs?
I think the question is actually, what can their actions do to avoid a recession at all? If you do have economic conditions where prices are increasing, growth is slowing, and unemployment is rising, the Fed has really one blunt instrument to be able to change the macroeconomic picture. So it feels a little bit like we have, a Phillips screw and a flathead screwdriver with this conundrum. So I think the question is not necessarily when will the Fed start to act, but really, if the Fed acts, will it do anything to actually soften the blow of this economic calamity that the president has really created on his own?
Well, and when we consider the president's own words about what could happen economically, he seems to be talking a lot, Liz, about what will happen through the lens of children's dolls, the availability of them, whether kids will be able to get as many and how much they will cost. But I do wonder, if it's not dolls, where you expect within the economy these shortages and potentially either empty shelves or higher prices for items that are shelved will start showing up in a more material way. How close are we to that moment, considering what we're seeing in cargo volumes coming over from China?
Yeah, I mean, at the Port of LA, we are now at a 50% reduction year over year. Just last week, Gene Soroka, the head of the LA port, was saying 35%. So the picture is grim. JP Morgan is expecting 70 to 80% declines in shipments from China. I think the president was kind of making an offhand comment when he said that the children might have 2 dolls instead of 30. And what he might want to turn his attention to is, the doll makers have said all of the hair for those dolls comes from China. And so it's not how many dolls they'll have, but if they'll be bald. But I think on a more serious note, 98% of car seats, 97% of strollers, 90% of first aid kits all come from China. These are essentials that parents cannot go without. And as we head into the summer season, more than 90% of charcoal grills and fireworks come from China. As these businesses we saw in the trade imbalance data earlier today that there was a massive spike in imports leading up to Liberation Day. These businesses are rapidly spending through their inventories so that they don't have to pay the tariff on new shipments. Eventually, they will run out of those inventories, and families across the country could see essentials not on shelf for them to be able to purchase pretty soon here. I'd say for most businesses, they typically have between 2 and 4 months worth of stock supply. Maybe some larger businesses were able to stretch that to about 6, but there's only so much stockpiling you can do.
Well, and as the Fed has said repeatedly, and as you were alluding to earlier, Liz, there's not much the Fed can do to address supply shortages. Their ability to impact the supply and demand dynamics is focused solely on the demand side. And I wonder, as we consider the interest rate mechanism and its abilities to influence demand, if actually what we could see is consumers themselves balking in the face of higher prices, bringing their own demand and consumption capacity down, and in some sense actually making it easier for the Federal Reserve if it's consumers that bring their own demand down, making the Fed not necessarily need to have tighter policy. Does that make sense?
It's possible. I mean, we've seen this a little bit from some of the fast food earnings reports out last week. You know, McDonald's, Chipotle are all reporting decreases. We'll see Disney this week, but by and large, I think consumers and businesses are really trying to put as many big decisions on ice as possible. We don't know what the president will announce tomorrow, if it'll be 1,045% tariffs on China or 0% tariffs on China. It is really hard as a consumer to make a decision about large purchases. Do I buy a car now because I expect that the prices will only continue to go up and my car might be on the verge of breaking down? But you had Ford announce large increases in their prices. As families are planning, you know, vacations for this summer, they're rethinking, is now really the right time to spend a couple $1,000s, or should we wait it out and see what happens with our jobs or with our expenses? And as businesses are considering hiring decisions, they're, you know, really thinking about, should I add a full-time employee right now, or can I make do with the staff I have? So I really think what we're going to see is largely an economy on ice. And the question is, as that ice melts, is the economy spoiling or flourishing? And I think it really remains to be seen, and the president's actions will have a large effect on those, and it's not totally clear what's coming out of this White House. You know, the president alleges that there's hundreds of deals he could announce, but he's not announcing any. I know Treasury Secretary Bessent and USTR Jameson Greer are traveling to Switzerland this weekend to meet with the Chinese. I'm not sure how much we can expect movement there, and so I really think it depends on how the president keeps course on his erratic trade agenda as to what happens with American consumers and businesses.
All right, Liz, we just have a minute left here, but if you had the chance to ask Chairman Powell a question at the press conference today, what would he need to answer for?
I think the better question to ask him is about his Grateful Dead fanfare, but I think what I really want to know the answer is, if faced with increasing unemployment and increasing prices, what tools are in the bottom of the depths of the toolbox of the Fed to make sure that American families do not pay the price of this president's erratic economic agenda? And I'm not sure he has an answer for that.
All right, well, we'll see if he gets asked a variation of that question this afternoon all the same. Liz, thank you so much for joining me. Liz Pancotti is Managing Director of Policy and Advocacy at the Groundwork Collaborative, helping us count down to this Federal Reserve rate decision, which of course is coming just 30 minutes from now. Again, they are not expected to change rates at all, expected to stand pat, which may be met with the displeasure of the President of the United States, who has reiterated time and again he would like to see an interest rate cut now. So watch the press conference, but also watch your True Social feed to see the president's reaction. I'll have more on that in the late edition of Balance of Power at 5 p.m. Eastern. In the meantime, a special edition of Bloomberg Surveillance, The Fed Decides, with Tom, John, and Lisa is straight ahead.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
Live from New York City this afternoon. Good afternoon for our audience worldwide. That Fed decision 27 minutes away, with equity markets positive on the S&P 500 by 0.4%. And how about this for a promo? Earlier on today, Francis Donald from RBC. I can't remember the last time I spent less time thinking about a Fed decision.
Well, that solves it. To me, though, you take a step back, and not that much has changed in markets since the Fed's decision on March 19th, and yet everything has changed on a broader level in terms of people's outlooks, and how they reflect that will be important and interesting, and certainly the markets will respond as much as they say that they're not.
I don't think there's a policy chapter on this in any monetary textbook. I mean, this is absolutely original. It starts at 1600 Pennsylvania Avenue. Do you think, John, they're going to be watching today from the White House?
Watching what? this news conference or the football at 3 p.m. Eastern.
Well, we'll get to the football in a moment. I think Arsenal really, do they have a
I think they've got the edge on PSG.
Honestly,
That's about how serious some people are taking this news conference later. It's important. Here's why. We've seen a generational shift in trade policy in the White House, in the nation's capital, and this Fed is stuck between a rock and a hard place. This chairman has emphasized anchoring inflation expectations, facing down potentially downside risk to growth, upside risk to inflation.
Yeah, Bob Michael of JP Morgan reminded us that it was just last meeting that the T word was rolled back out, transitory, which is rather shocking considering the sea change that has occurred in the meantime. That is the key question. How do they message going forward what type of inflation we end up getting at a time where not only have we gotten the tariff announcements, Liberation Day, but also the first negative real GDP print? How do they message that?
I ran into Anna Wong. She was getting in at the crack of 11 a.m. and she's back to October. I think there's some real debate here about which meeting and when, and she says the uncertainty is so great, she moves back to the autumn.
The data has been resilient so far. Anna Wong, though, pointing out it might not be that way after you take a sneak peek of what the data will look like for the month of May. Equities at the moment firmer by 1/3% on the S&P 500. A lot has changed in policy. To Lisa's point, at the index level on the S&P 500, not much has changed at all. Where you have seen a change is in the FX market. The last time they met, we were sub 110. Right now on euro dollar, 113.41.
Yeah, and gold up 11% in that period of time. Coming up shortly, don't miss this, JP Morgan's Bob Michael, Kathy Jones of Charles Schwab, and Julia Coronado of Macro Policy Perspective. They will be taking us up to that Fed rate decision at 2 p.m. Eastern. Everyone is on tenterhooks to try to understand what it possibly could be. Then immediate reaction from former Fed Vice Chair Rich Clarida, Diane Swank of KPMG, and Deutsche Bank's Matt Lazzetti. And finally, the scintillating words of Chair Powell after his news conference. Former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg will be joining us. And I can tell you, I am excited for this press conference.
I'm not excited about it. Can I say that? Really? Bob Michael at JP Morgan. Let's see if he's excited. Bob, let's get to it. What has changed since March 19th? A massive change to policy. What's changed for this committee today?
Well, they've got a lot to consider. They know that there are these two big policy initiatives out there. One on renegotiating and re-engineering how the world trades with each other, not small in and of itself. And Congress is busily beavering away on a tax and spending reform package. So both of those things are seismic for the Fed to consider when we see the details. And until we see the details, they're probably a bit like us, bewildered as to what to do.
Do you think they're going to roll out the T word again?
I think that's going to be retired. I don't believe that makes sense right now. No matter how you model tariffs, whether you think this will end up closer to 10% or in the worst case scenario, somewhere closer to 20%, it is a tax on businesses and households. And that tax, of course, is a price increase, and we don't know how it will be embedded going forward.
Bob Michael, my book of the summer, Ken Rogoff, just out 2 days ago. You spent some time with Dr. Rogoff at JP Morgan. He did a paper 25 years ago on Rudy Dornbush about this fearful word, overshooting. What is the risk to this institution, our central bank, that they get this math right, they get it wrong, the calculus wrong, and they overshoot or undershoot some of these important policies?
I think it's actually pretty low. I think relative to 25 years ago, when Ken and others were looking at markets and policy and data, they didn't have the volume of real-time information that they have today. I think the other thing very important about the Fed, they have a lot of powder that's dry. They could come in, they could cut rates several hundred basis points if they need to. They could bring rates down to 1 or 2%. They're not at 1 or 2% where they were going into COVID. And if inflation expectations become embedded, they could go up 100 or so basis points. And then there are all the other policy tools they have in place. They have the balance sheet. They could dial larger or smaller, and then they have all the facilities to buy security.
This is a really important observation because they've tested lots of these things. which we haven't in previous conference.
They've tested a number of these things, but this is a different era. And I think it's important to know what John's pointed out, that there has been a sea change in markets. It hasn't been in the bond market. It hasn't been in the stock market. It's been in the currency market. You've seen the dollar weaken dramatically against all of its peers. How much does that remove some of that firepower from a Fed that is dealing with potentially a new backdrop for the bond market and, frankly, for U.S. assets more broadly?
I think that's the question for Jay Powell at the press conference. The Sell America theme, how do they define it? What are they looking at to gauge whether it's actually happening or not? Is it institutions selling dollar assets in retaliation for terms of trade, or is it normal portfolio rebalancing? From our perspective, we think what we've seen so far this year is normal portfolio rebalancing. And yet, there have been some lever trades that have been squeezed out that have exaggerated the moves. But we're not seeing the big holders of treasuries that are overseas, that are structural buyers, coming in and dumping them. But I think he has to pay attention to that.
Can you explain that? What is normal portfolio rebalancing? What's the difference and how do you identify between the two?
Well, it's looking at a portfolio and thinking there's a lot of opportunity out there. Are you crowded into one specific trade or area? And the dollar became a very crowded trade. And we saw that from our client base. We saw a lot of overseas buyers just wanting to hold dollar bonds unhedged. And of course, we've seen that in the equity market, whether it's the Mag 7 or U.S. equities in general, they took the lion's share of flows.
You speak to those international investors. Have those conversations changed? Are they worried about other people repatriating investments back into domestic currencies, a home bias taking hold of their investments? And are they looking to get ahead of some of that? What are they saying to you?
So the large-scale official institutions right now don't see the Sell America trade. They're happy holding what they're holding. They hope that the trade negotiations progress palatably and things fade somehow. When you start talking to wealth management platforms and distributors, yeah, they're thinking about maybe we just got too crowded into the dollar. We have a European client base. Why don't we bring some of that back to Europe and put it into the U.S. equity or bond market? I think that's relatively normal. We were looking for that anyway.
We keep going back to this, Lisa. We've talked about it a million times. Is this a cycle level shock, a rebalancing, or a system level shock where people start to diverse away from the US dollar because the White House, the administration, is absolutely determined to rewire the international system and change the system? And I think the risk is that international investors start to worry that it is the latter and make a move ahead of time.
And take that a step further. For Fed Chair Jay Powell, how do you deal with that level of uncertainty, not only of the economic backdrop, but also of whether it's a regime change that fundamentally changes how they respond because their function as central banker to the world has been greatly diminished?
Is the answer do nothing and wait? Just wait and see. Get through the summer and see what it looks like.
And I think you go to the press conference and you only use three phrases. Solid for anything that refers to the economy. You talk about the labor market being solid. Anything that refers to inflation, you throw out somewhat elevated, and hence you have the moderately restrictive policy. And then anything that talks about their dual mandate, you say that everything is well positioned with policy.
Lisa said this a number of days ago. It's Operation Get Out of There Fast. Wrap it up, end the news conference. It's going to be one of those that finishes at like 3:15.
So this is the time when he does a Homer Simpson. There's a shrub, and he just tries to back into it, disappear with his hat still stuck in the leaves. That is what this is going to be.
TK's looking for that meme.
I'm looking for
when he disappears into the bush. Do you know that one?
Yeah, I know that one.
He sort of backs away.
I've seen every episode, Johnny.
Yeah.
You know, it's heritage.
Including the football one, which you really like. I know.
We like the football.
I know you really do.
Between that and Toto, it works.
Do you know, he used to troll me all the time when we first started doing radio together. He'd start the segment and he'd play the Simpsons and the football commentary.
Oh boy.
What was it? Back pass, how did it go? Something like that, right?
Captain of the midfield the captain, and then we play Toto Africa. We could play Toto Africa today, John.
Let's not do that.
Oh, man.
Bob Michael's going to be sticking with us, I'm pleased to say, to talk about markets. Kathy Jones and Charles Schwab joins us in just a moment, alongside Julia Coronado of Macro Policy Perspectives.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
I've never seen cash machines as lucrative as these companies are.
Just close your eyes and buy.
Many Koreans find this really shocking and unbelievable.
This needs to be a wake-up call for Europe.
You can have only one captain of the ship, and we are the captain of the ship.
You love it or hate it, you can't ignore it.
Insight with Haslinda Amin, only on Bloomberg.
The top names at the Fed are on Bloomberg.
I'm not going to overreact to any increase in inflation that I think is attributable to the tariffs. But if I see a significant drop in the labor market, then I'd be ready to go. I wouldn't be sitting here waiting to determine whether the inflation is transitory or not. It's time to worry about the real side of the economy. I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
Nobody covers the Fed like Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
I can't remember the last time I spent less time thinking about a Fed meeting.
They will do nothing on rates.
There's no reason for the Fed to be cutting.
We don't think they should be cutting.
We expect cuts this year, but we just don't expect them, immediately.
Wait for more clarity.
Wait and see.
I don't think they can offset a full impact of the trade war.
It puts the Fed in a tremendously difficult position. The Fed's hands are tied.
They're very timid in how they are approaching this.
They're going to move relatively slowly.
The Fed should continue to remain on hold for a longer period of time.
The Fed is really, really between the rock and a hard place.
Chair Powell is going to have to master the art of saying nothing.
The desire is to get out of this without making any news.
60 minutes of tap dancing coming right up. The decision 15 minutes away. 30 minutes after that, 2:30 Eastern Time, a news conference with the chairman, Jay Powell. Your equity market this afternoon shaping up as follows. Snapping a 2-day slide on the S&P. We're positive by just 0.2%. In the bond market, back on March 19th when the Fed last met at the close of the 10-year, 424. Today, 428.10. In the FX market, a lot has changed. Euro dollar, the last time these guys met, 109. This afternoon, 113.38. Lisa, huge change in the FX market.
To me, this is the big change, and it's the one that Fed Chair Jay Powell will avoid at all costs, because ultimately it goes to the heart of the question: how much is this just a sea change in expectations globally, and how much is a fundamental shift in the dollar as a reserve currency?
And also, I'd say very importantly, you really see it through BBDXY, the Bloomberg Dollar Index. EM currencies are doing some strange things. I looked very carefully today at the Taiwan dollar. When was the last time I did that? When Tottenham won. And the answer is, I look at Taiwan dollar, John, and it's very, very fragile. These shifts in the Pacific Rim are for real.
Lucky not to get relegated, aren't they?
They're very close.
Not a good season.
I can't sleep.
We're not going to talk about that, okay? Big dislocations in FX markets. To discuss, Bob Michael at JP Morgan, still with us around the table. He'll be with us through the decision and approaching the news conference, and joining us now, I'm very pleased to say, Kathy Jones of Charles Schwab. Kathy, welcome to the program. No new forecast from the Federal Reserve at this meeting, but I wonder, just a thought exercise, if we had any SCP today, if we had an update to the forecast from the FOMC, how much do you think those forecasts would change?
Well, I think they would change and indicate more of this sort of stagflationary environment, with inflation remaining elevated and growth slowing down. Most of the data that we've seen, other than, say, the employment report, does point to the idea that we're getting slowing growth in the second half of the year. The question is, what will they do about it?
There are a number of questions about how different the feeling will be in this speech, in this press conference, than the one just on March 19th, including the transitory word, which Bob Michael is talking about. He doesn't see that making a comeback, but also the soft data versus the hard data. How much do you expect Chair Powell to reaffirm the idea that the soft data has not necessarily cohered with the hard data, and they're watching the hard data much more closely than anything else?
I would suppose that he'll make that statement that, the real economic data that they're watching, the real-time data is still holding up, especially the labor market, and therefore there's no reason to adjust policy right now. I think the bigger question for me is how are they assessing the inflation expectations component? Because that's where we're starting to see less well anchored, I would guess. Last time in the press conference, Powell indicated that inflation expectations are well anchored. And we've seen evidence that that's kind of giving way. That anchor isn't as firm as it was. So I think that's going to be a tough question for him to answer. And I'd be curious to see how the Fed is thinking about that.
Hey, Cassie, I'm one of the LIBOR, for everybody who dressed up in a tuxedo and figured out where interest rates were for cocktail hour. LIBOR's gone. We have SOFR. You had a very smart comment today on SOFR, SOFR. It's a 2-year rate. What do you see in the short-term trust market now when you look at 2-year SOFR swaps?
Yeah, what we're seeing is this divergence between expectations and where we are, right? So you look at CPI swaps, and by the way, I have to give credit to Bloomberg Intelligence for pointing this out. But it does look to me like we're starting to see those swap rates reflect inflation expectations staying higher. Or inflation staying higher down the road than what we're seeing in the SOFR market, which is more rate-based. So it'll be interesting to see how the Fed kind of brings those two together, because inflation expectations are a big part of their policy setting and a big part of how they see what they do affecting the markets.
Hey, Kathy, I love hearing what you tell individual investors to do in environments like this. What are you telling them to do in environments like this?
Yeah, we're hoping that they've been following our suggestions for the last, 6 or 8 months, and that is just a intermediate term duration, meaning, 5-7 years, maybe a little bit beyond even, given the slope of the yield curve, in high credit quality bonds. And try not to time the market with, being too short and saying you're going to roll in, when things change. Try not to be too long and take on that interest rate volatility. But we want to stay up in credit quality, intermediate term, and more internationally diverse, because the dollar does look like it's turned, and we think it's going to continue to work lower over time. Of course, tariffs are a wild card, but for the first time in a long time, international diversification in developed market bonds looks like an attractive proposition.
Bob, it's interesting. I've heard this argument quite a few times now. There's comfort level with the belly of the curve. If you ask anyone in fixed income, look along the curve, where are you comfortable? And I keep hearing the 5-year. And then I say, what about further out, 10s, 30s? Do you think they'll rally if we get into some trouble here in the economy? And they've got doubts. What's your reaction to that argument?
Yeah, I think everyone's worried about a stagflationary environment where the Fed actually does come in and start bringing rates down because unemployment starts shooting well above 5%. And in that environment, the front end of the curve will reprice to where the Fed funds rate. However, if you're going to be in the long end of the curve, particularly 30 years, you want some real yield out there, and you won't be getting it if inflation shoots up towards 5% as well. Let's build on this conversation. Joining us now is Julia Coronado of Macro Policy Perspectives. Julia, a big conversation about whether this Fed can ease in the face of weaker growth prospects. Now, at the last meeting, as you saw implied by the SEP, they took their growth expectations down, but didn't dial up the median dot for rate cuts. Julia, from your perspective, what are you telling clients about the ability of the Federal Reserve to respond to weaker growth?
Well, their ability is definitely more limited during the last than during the last trade war, when inflation was below target. So by definition, with challenges to both sides of your mandate, and you're starting from a point where you are exactly on the longer run estimate of the unemployment rate, but you're still a solid 0.5 percentage point plus above your 2% inflation target, you have to be a little bit later. You have to gather the information. The bar for what you need to see in terms of weakness in the economy is a little bit higher than it would be otherwise. Last time around, we got preemptive insurance rate cuts just to cushion the blow to the manufacturing sector. Now we're looking at a multiple times increase in tariffs, a much harder blow to the manufacturing sector. But, you know, again, the inflationary backdrop is very different, and potentially the international trade-offs that you guys have been discussing are also very different. So the Fed really needs to be cautious here.
Julie, if we get a Bob Michael 5% CPI, my math is 2.4% to 5%, maybe it's a little less. That's a 108 percentage point move in the inflation rate. All of our viewers and listeners are going to be crushed by that.
Yes.
How quickly does the Fed move? Should we anticipate 50 basis point cuts?
For sure. At some point, I think that's a perfectly reasonable expectation. Again, the bar is higher. It has to be a pretty decisive indication in the labor market data that we are sliding into a recession, that we have gone from the positive feedback loop of growth to the negative feedback loop of contraction. Then the Fed is going to turn to that side of the mandate. If you look at peak to trough declines in core inflation in the average business cycle, it's several percentage points. So it still is a sort of law of nature that inflation is likely to come down in a recession. And you're starting from a much higher point on interest rates than we've been in the last couple of cycles. So there's room to move. And of course, we can imagine in the scenario where we're seeing losses on non-farm payrolls and a rising unemployment rate, financial markets might also be tightening conditions, and the Fed will need to signal that it is on the case. And so, yes, I think a 50 basis point move at some point is a perfectly reasonable expectation. When that is, we would really have to see the rollover in the hard data.
Just look at what these markets, these investors and these officials are up against. Bring up the S&P 500. We've just taken out all the gains for this afternoon on one headline from the President of the United States, Lisa, saying no to the potential for pulling back tariffs on China. As an official of the FOMC, how do you set policy for this when you can dial up and down tariffs whenever you want in the White House, and that can have a profound effect for how people perceive the risk to the outlook?
This is the reason why Fed Chair Jay Powell is going to try to disappear. He also is asked about President Trump about tariff exemptions for baby items. I don't know. We'll see who says. I'll be the one to sign off on this. There is a level of uncertainty that's starting to make its way into the hard data, with companies starting to price that in as a level that they have to guard against.
Kathy Jones is still with us. Kathy, I want your thoughts on this headline. We were going into a meeting this weekend between the US and China. A lot of people were hoping that that would mean tariffs eventually would come down for a bigger set of negotiations down the road. How do you respond to that headline? And what does it mean for the FOMC as they get together today?
Yeah, I think this is the toughest part of Jay Powell's job right now, because there's so much unknown about the tariff policy, and it can change in a heartbeat or with a Truth Social post. And how do they assess then what the impact of tariffs will be on the economy if they don't have the tariff rates yet solidified, or if they can change really quickly? And the second part is, how do they know that their interest rate policy will have that much impact if it's a supply side shock that we're getting? So I think that's a really, really tough thing for the FOMC to deal with. And I think they'll take baby steps and be very cautious until they get some information. But as you pointed out, this can change day by day, minute by minute, and setting policy is not done on a day by day, minute by minute basis. So it's going to be really tough.
This makes it super difficult to act preemptively. And Bob, it's the reason why a lot of people have been with us around this table and said they're going to be late. They've got no choice but to be late. Is that how you see things?
My London-based fixed income team sent me something this morning which terrified me. They liken the current environment with tariffs to Brexit, where you can sit there, you can model all the impacts, they're all to the downside. But because you haven't seen the impact yet, there's a complacency that takes hold of the markets on the expectation it will be worked out somehow. And it wasn't, and the downside was realized. I hope this time it gets worked out in advance.
Bob, the new ex post that we're living in, I get two ex posts. I got an ex post on interest rates and, you know, the shock of 5% inflation if we get there. And I got an ex post on the labor economy. I don't think any textbook has how they dovetail together. To me, it's almost a squared function. Is our new ex post, is Jerome Powell's new ex post, is it something absolutely original?
I don't think so. I
think it's business as usual.
I think they have no choice but to look at their dual mandate and try to balance the labor market with inflation. If they can't save both, which is it more important to save? And I think they'll choose the labor market and the economy and hope at some time inflation will run its course.
Bob, can you just build on what you were saying in terms of those comments that scared you? The downside, do you still see people flooding into long-term treasuries if that downside is realized? Or is that part of your concern in terms of some sort of relevance with Brexit and Liz Truss?
Well, it is part of my concern. And the other thing that did change from the March 16th FOMC meeting, the front end of the curve is down 25 basis points. The 30-year is up 15 or so basis points. So that's already starting to become manifest in the pricing of the curve. I think what we learned from Brexit is you knew the supply of labor and goods would be cut off. You knew inflation would reset higher. And you knew that would create a hit to the economy. And everyone hoped that there would be some moderation around that. And I think that's the overall concern that investors are trying to weigh now. How significant will the inflation shock be? Will it actually fade next year, or will businesses have no choice to pass that along? Consumers have no choice to pay it, and then you're caught in a wage price spiral again.
And this is the challenge for investors. We asked the question this morning, just how much can the promise of deals sustain this market? The promise of deals has driven this equity market higher to a significant rebound. So you sit there waiting. And to Bob's point, complacency can come into it. And all of a sudden, it's this slow erosion of the economy as a lot of people just snap into this wait-and-see mode. And before you know it, you hit an air pocket in the economic data, and you've got to respond to that too.
Suddenly you get a jobs report that is not what people are looking for. I wonder how soon it will come, if it's possibly next week with inflation. Ford said it wasn't going to raise prices on vehicles in response to tariffs. It is raising prices. It is the test out there to see whether consumers will actually absorb it.
That decision is just seconds away. Your scores going into it look like this on the S&P, erasing gains on the S&P 500 as the president says he's unwilling to lower tariffs to get China.
Economic activity has continued to expand at a solid pace. No change to their view. The labor market remains solid. Unemployment has stabilized at a low level in recent months, and inflation remains somewhat elevated. No other changes to the statement. Again, the committee will assess incoming data, the outlook, and balance of risks in considering the extent and timing of additional adjustments to the target range. There's no change in balance sheet policy, which was adjusted in March, and the decision was unanimous, with Minneapolis's Neil Kashkari voting as an alternate for Kansas City's Jeff Schmidt.
And our thoughts are with him, that's for sure, given the circumstances that led to that. Mike, thank you, sir. Mike's on it, second paragraph at the very bottom of it. The committee is attentive to the risk that both sides of the dual mandate and judges that the risks of higher unemployment and higher inflation have risen. And that is the central banker's dilemma.
The stagflationary environment that every central banker wants to avoid. The initial knee-jerk response in markets is interesting in that its yields lower. There is a question whether that can continue all across the curve, as there's a question around just the new structure of trade and the uncertainty that is weighing on businesses.
The problem is with the market response, Bramo, as you know, we're competing with the headline from the President of the United States, which is perhaps more significant than anything we hear from Chairman Powell in 28 minutes' time.
Okay, fair enough.
The President coming out and saying we're unwilling to lower tariffs to get China to come to the table. That's what they're confronting in this meeting. How do you set policy for this when for the moment in time, that's the headline? But that could change again this weekend and again next week and the week after that.
How much is communication a monetary policy tool when you're communicating the same thing that everyone's communicating, which is we have no clue and we are waiting for that tweet or truth that's come out and give us some sense of where the next move is going to come from?
With us around the table, Bob Michael of JP Morgan Asset Management, and our guest for the next 28 minutes going into the news conference, the former Fed Vice Chair, Rich Clarida. Rich, thanks for dropping by. An important conversation. Look, a lot of people say this news conference is going to be boring. I get it. You're not expecting a big change. But they face a really big dilemma. The dilemma that they articulate in this particular statement this afternoon, the prospect of the dual mandate is in conflict. Rich, what do you do when the dual mandate is in conflict?
Well, you wait and see for a while, and I would note that the language appears to me to be quite similar to the remarks the chair gave a day or two after Liberation Day, so not the first time he's telegraphed a change in statement.
OK， 好，兄弟们，美联储的这个会议已经出来了啊，那么不降息啊， 联邦的这个基准的利率区间维持在4.25%到5%之间，那么也就是不降息啊。那么现在呢，他们这个中文的这个说明啊，还是要充分的就业和2%的通胀率，那经济前景的不确定性啊进一步加剧啊，这个是因为关税的问题啊，关税战的问题。那么现在来看，这个是将仔细评估后续的数据不断变化的前景啊，以及这个风险的平衡。委员会呢将会怎么出现这个东西？继续减持美国国债啊，这个地方很关键啊，机构债券以及机构抵押贷款啊，支持证券。那么委员会呢会坚持的致力于充分就业，并将通胀率恢复到2%的目标。好，那么大概就是这个意思啊。行，那我们继续来看这个，美联储的这个是出来了吗？不降息啊，不降息已经宣布了。那等一下还有25分钟，鲍威尔会出来讲话啊。不降息，我们看一下比特币的走势。不降息，反而比特币是小反弹，这个是有点诡异啊，走势。
Them to key economics concepts and potential
language from a speech. I still believe, and I think I've said on this show before, that if the labor market cracks and they see tangible evidence of a weakening labor market, higher unemployment rate, in which I was there, in which inflation was not transitory, it was above target. This could be the 5th year in a row, and I think that's why they're looking at inflation expectations.
Equity markets rolling over this afternoon. As Lisa pointed out, bond yields are lower. We're down by 4 basis points on the 10-year, 426. When they last met, March 19th, at the close, 424, almost bang in line with where we were a number of months ago. But a lot has changed, which is why this line pops up in the statement. If you're just joining us, no change to policy expected, but some new language here. The committee, attentive to the risks of both sides of its dual mandate, and judges that the risk of higher unemployment and higher inflation have risen. Mike McKee, I want to bring you back in before you run off to this news conference. Mike, as you know, those comments at the Economic Club of Chicago a number of weeks ago maybe irked this White House and the President of the United States. What are you expecting to hear later on this afternoon?
Well, I would imagine now that it's in the statement that Jay Powell will stand behind it. And of course, it's what he said in Chicago. Now, the question is, how is the president going to react to this? Because he was upset about the Chicago version of this that came right after Liberation Day. But the Fed otherwise doesn't mention the administration or the White House, except to say that imports affected GDP. So is this a poke at the White House, or is this just accepting reality and trying to get the markets to accept it?
Mike McKee with the latest. Mike, I know you've got to run. Mike McKee heading into that news conference. The news conference, by the way, starts in about 23 minutes' time. Bob, your view on what's happened with central banks elsewhere. The ECB cut interest rates. This president was annoyed by that. Overnight, the Chinese central bank cut interest rates. I imagine this president is annoyed by that. They look at the same policy shock but see a different outcome. Abroad, they believe this is a disinflationary, potentially deflationary shock for Europe. What kind of shock is it for this Federal Reserve?
Well, I think for this Federal Reserve, they're worried about the stagflationary shock. They're worried about exactly what they talked about, which is inflation goes up 4% or higher. Unemployment goes up, closing in on 5%. Now both are kind of at a similar break-even level. What are you supposed to do? I'm in Rich's camp. I think you've got to save the economy, because if you don't save the economy, then you've lost on both mandates.
You live some of this, Rich. I just wonder how you'd live it. right now. It's so public, the criticism of the Federal Reserve. As a committee, when you heard these kind of things, you saw the social media posts when you were on the committee.
Oh my, yeah.
How did you deal with them?
Well, after a while, you sort of get used to it. And what I would note is that there was some criticism of the Fed when we hiked rates in December 2018. And then there was criticism of the Fed when we cut rates in July of 2019. So at some point, you put your head down, you do your job. And of course, the mandate is price stability and maximum employment. And so that's the way I thought about it and the way we thought about it.
Rich, what do you make of the fact that they dismissed the first negative real GDP print in a long time, in years, as simply swings in net exports? Some people would say that's accurate, but the fact that they led off this statement with that really highlights how much they are shrugging off some of the negative economic indicators that are glaring.
Interesting observation. I think there were good economic reasons to shrug it off. I mean, the surge in imports and probably some measurement issues. And I had been thinking and been saying I thought they would shrug it off if it came in negative. That said, it was interesting that they did choose to lead off with that observation. I think that is another way of them saying they think they're in a good place. They'll wait and see. Had they emphasized the negative print, it might have been more difficult to justify what they want to do.
You'll notice this equity market has taken another leg lower. We're down about 4%, 0.4% on the S&P. Don't get too excited. On the S&P. It's not that exciting this afternoon. Let's talk about the why. We've got some conflicting information. At the same time, the Federal Reserve is saying growth potentially could be weaker, unemployment could be higher. They're also facing down the prospect of higher inflation as well. The President of the United States is not backing away from the tariffs from China too. You combine those two stories, you've got a weaker backdrop for risk going into this news conference.
This is the worst of all worlds, especially given the fact that Fed Chair Jay Powell is not going to do what a lot of people thought he would do, which is to come out and say, we're very concerned, we're going to cut rates, don't worry, we got your back. No one thought he was going to say that, but some people were hoping that maybe he would, including somebody at the White House. To me, this represents the dual shock that the Fed cannot address. And to me, that is the key question. What other tools are at their disposal, and how are they watching market functioning as a virtue of that 10-year and 30-year yield at a time of some potentially messy auctions?
To build on that, to extend the conversation, Diane Swank of KPMG joins us now for more. Diane, welcome back to the program. I remember when we were talking last time around on March 19th, you and I were both in agreement. We looked at the SEP, we saw a weaker forecast for growth and no move to the median dot. We both said this is hawkish. This is a Federal Reserve whose easing bias might be constrained. Dan, do you think they're communicating that a little bit more clearly, even more clearly, in today's statement?
I do, and I guess I disagree a little bit with Rich, and I know he was at the table, but I think back to that 2022 Jackson Hole, Wyoming speech, which was like the there will be pain speech. The bucket of ice dropped on our heads when the Fed was put in a situation where they had to worry about inflation over unemployment, and they thought a recession may ensue. Luckily, it didn't. They were willing to make that decision to go ahead and raise rates anyways because they were behind the curve and still catching up at that point in time. And I think they're still smarting from that period. I also think it's important. I was in Chicago when Jay Powell spoke, and he made an important point in the Q&A, and that is that no matter what, the bump in inflation due to tariffs would be temporary. That means that they hold off a bit before, as unemployment rises, or we get some red ink on unemployment, and then they cut. It is not only not preemptive, they have to wait in order to make sure that inflation is coming back down again in the fourth quarter.
Rich, in preparation for this meeting, I was reading the economist Oscar Wilde, and he said, expect the unexpected. What's your unexpected right now? I got all my radar up. We've all got answers. We've all got analysis. We've got our monetary textbooks out. We're reading Mankiw. Guess what? What's the unexpected out there?
Wow, so I guess we're into known unknowns and unknown unknowns. I guess to me, the unexpected would be if Mike McKee or someone asked Jay Powell today how they would respond to a rise in the unemployment rate if he repeated what he did at Jackson Hole 3 years ago, which is some pain, inflation's too damn high. So that would be the unexpected at this press conference.
What does pain look like? Rich, what is pain? Because quite clearly, if I lost my job, that's painful for me.
Yeah.
If the three of us lose our jobs, I hope it's painful for you. You'd miss out on a lot, I'm sure. I want to understand when it becomes painful for the Federal Reserve. What kind of number is painful
Well,
for the Fed?
I think I put it out a moment ago. I think round numbers, I think certainly if we got a 1 point rise in the unemployment rate, I think probably even a ½ point rise in the unemployment rate in the context of a cracking payroll employment report would be enough. I think probably the only person who knows for sure is probably Jay Powell, so I'm just guessing, but to put round numbers on it. Yeah.
Diane, what's your view of this in terms of the pain that would get the Fed's attention at a time where, as Rich has put out, there has been elevated inflation for years above where the Fed has targeted?
Well, and I actually agree with Rich on the degree of which we'd see the unemployment rate go up that would precipitate the Fed to feel comfortable that it could begin cutting because the demand is so weak that inflation will come down. But that is after the fact of inflation actually going up. And remember, unemployment is a lagging indicator, and I think that's important. We also have one other factor out there that we've yet to see fully influence the labor market, and that is whether or not the change in immigration policy results in lower labor supply, which was part of the soft landing scenario, but it also will mean a slower increase in the unemployment rate if we lose the participation of those foreign-born workers. So all of those things together leave us with a period of the economy with maybe red ink in payrolls before the Fed actually cuts. And I think that is the important message. The timing is only maybe a few months apart, but that not preemptive, but also not synchronous, I think is what we have to walk away from.
But Michael, one of the arch things here is Michael Feroli's thoughts from years ago about such a low potential GDP number. Maybe we got saved by productivity, who knows, maybe it was triple stimulus in that. But in your framework of the debt market, around Clarida's economics, do you just frame in a new lower GDP that we have to get used to?
No, I don't think so. And I think if you talk to Mike Feroli today, he would tell you that the post-GFC environment has faded. There's a new generation that's in place, call it loosely the millennials. There will be a demand in costs and productive use of capital. So we're going back to an environment that existed pre-GFC. I think what's interesting to me right now is the markets have voted. And if the FOMC is going to tell them that that the risks are higher unemployment and higher inflation, neither of those are good. So equity prices are down, bond prices are up. At least we've got sort of right-way correlation today.
John, have we heard from President Trump yet?
Not yet, not the Federal Reserve directly, Lisa, but I think he's shaken up this market already.
I was going to say that the fact that he said he was unwilling to lower tariffs to get China to the table is a pretty big headline that maybe is getting more of the attention in markets than elsewhere. But Rich, to Bob's point, and this is a good one, and it's one that actually Treasury Secretary Scott Bessent made just a couple of days ago, the 2-year yield is screaming that the Fed should have already cut rates. Do you buy that type of reasoning that this market is pricing in a slowdown that the Fed should preemptively respond to?
The market is pricing in a material probability of a recession, and Secretary Bessent's entitled to say then the Fed should cut. I think what we're hearing and what we'll hear today is that's a risk that they're willing to take given the history of inflation and given what they see down the pipe. So the markets are pricing in 40-50% chance of recession. And as you pointed out 5 minutes ago, the past 30 years, the Fed typically already by now would be in preemptive mode to ride to the rescue. But again, history is relevant here, and that's why this time is going to be a little bit different.
To ask more directly, though, what do you make of the specific argument that the Treasury Secretary is pushing? The idea that the 2-year yield is trading below where Fed funds is, and he believes that's a sign potentially that the Fed's too tight and the market's telling them to cut. Is that a good measure of things?
It's a sign that the probability of recession has gone up, and that in that scenario, we all think the Fed will be cutting. The difference is that I don't think, anyway, that the Fed's going to be cutting to try to get ahead of that curve. As Diane said, the very real risk is that they're going to be late, and certainly not early.
Diane, based on that, how much has the risk of recession gone up just in the past couple of days, given the fact that it seems like the Fed is going to reiterate that point?
Well, our view has been the risk is 60% for some time now, and I would bet that poly markets are probably back up to 60%. They had come down just a little below that in recent weeks with hopes of more toned down rhetoric with regard to trade tensions, and now that's being unwound today. I think the risk that what the Fed has to do, and Rich knows this as well as anyone, and what we're doing, and it's a lot more work, is probability and scenario analysis. That's all we can do. We put on a certain probability on what tariffs will be in different kinds of regimes and how they're likely to play out, and and sit down and think about how would the Fed, stepping in their shoes, have to react to all those scenarios. So our recession scenario is 60% probability.
Companies are doing the same thing. Diane, just before you run, that news conference starts in just a moment. Your number one question for Chairman Powell at the moment, what is it?
Well, again, it gets down to how much pain are you willing to endure before you feel you need to cut? And that's, Rich has answered it. It would be nice if Jay Powell answered it. I don't think he will, but it is one that we all need to know is, what is the pain threshold and the trade-off for the Fed, and how late are they willing to be?
Diane, thank you. Appreciate it as always. Diane Swonk there at KPMG. We've had the decision from the Federal Reserve. No change to policy. The news conference starts in about 11 minutes' time. This stood out in the statement. If you've not read it yet and you're just joining the program, welcome. This stands out. The committee is attentive to the risk that both sides of the dual mandate and judges that the risk of higher unemployment and higher inflation have risen. To discuss, Matt Lazzetti at Deutsche Bank joins us now for more. Matt, welcome to the program. Is that your assessment of things as well? Do you share that view of the FOMC?
Yeah, I think no doubt. If you look back relative to March, uncertainty has clearly risen. We've gotten tariff effects and tariff announcements that were substantially larger than anticipated. Downside growth risks to the economy have clearly risen. Upside risks to the unemployment rate, inflation risks are clearly higher. So I don't think anybody would really debate at the moment that risks are far more elevated today than I think that they were back in March, and from a stagflationary perspective, that inflation is likely to be higher and the unemployment rate is likely to be higher.
It seems like there's a bias right now in markets, Matt, that the unemployment rising feature of this dual mandate is actually more important than the inflation side of the mandate, and that if unemployment rises enough, the Fed will respond to that even if inflation is still elevated. Do you think that needs to be pushed back on, that maybe that's not the bias that should be there?
Look, I think that's right to be the bias. The question is always kind of thresholds for which the unemployment rate needs to rise to get the Fed to act. And there I do think that the market may just be anticipating that the threshold is lower than what the Fed is actually willing to deliver on. At the same time, I think you do have healthy dynamics. I mean, we got a better ISM report, ISM services, you had a jobs report that surprised the upside. With that, we've substantially taken down the probability of cutting rates by June. Now, a lot of that's getting priced out to later meetings. But if I were the Fed, I wouldn't be too perturbed by market pricing at the moment. They probably agree that recession risk is elevated. And we'll just kind of have to see how that plays out. I think importantly for them, the market is responding to stronger data by reducing near-term rate cut probabilities.
Matt Lazzetti, David Folkers Landau got it right. He said there would be a new Europe, there would be a new investment in Europe, maybe a new nominal GDP, a higher pulse, if you will, for Europe. That's one of the unexpecteds here. What's the unexpected you're looking for that we're not talking about?
Look, I liked Rich's unexpected, which is that Chair Powell highlights that we're willing to take pain here. I don't really anticipate that we get that. I think near-term unexpected would be if he it gives clarity that they're still in no rush to cut rates. Essentially says that June is probably off the table. I think at the moment the Fed is likely to just take a step back, not provide much forward guidance, let things play out as they come. But I think importantly for them is going to get clarity on two things: trade, but also fiscal policy. Because I think if fiscal policy and tax cuts are larger than anticipated, then this turns into something that looks kind of like a mini COVID shock. You have a big supply side shock from tariffs, immigration being coupled with a demand side stimulus from tax cuts. And I think the Fed will really want to see both sides of those policy decisions.
You're fired up about this, but take it internationally. Take it to the stimulus in Europe, to a higher nominal GDP. The true unknowns we don't understand about a China fiscal policy and the mess that's in Washington.
I guess on both of those, Tom, I'm even though I grew up in Illinois, I'm from Missouri on those. I mean, the Europeans have talked for decades about this. We get it, more demand growth, more fiscal space. The Germans maybe will pull it off. What I'm hearing from my colleagues in Europe is it's not clear the rest of Europe is going to do that. Again, the same with
begin to see the opportunities that are.
好，马上出来了啊！大家不要等我讲话了，这个咱们这有中文的自动翻译字幕啊，马上鲍威尔就出来了。现在大家看到的画面就是美联储的鲍威尔的讲话啊。OK， 等鲍威尔说 Good afternoon， 你就可以开空了啊。好，来了，兄弟们啊。
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There have been tariffs put on, tariffs taken off, and meanwhile, there was a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment? I think it's too early to know that. So, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think, if you look at where we are today. We have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Chair Powell, there's naturally a lot of debate around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, Housing imbalances look nothing like they did 4 years ago. Labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And, you know, we'll see the administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
You know, as I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And you know, when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and you know, as that develops, and I can't really give you a time frame on that.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, so let's look back and see where we are. So to go through 2024 up to the day, we've had you know, unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive, because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. We're not in this situation, but the situation is if the two goals are in tension. So let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. We haven't faced that question in a very long time. So again, difficult judgment to make, and not one that we face today. And we may never face it, but we have to be keeping it in our thinking now.
Edward.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
It's going to depend. I think you have to just take a step back and realize this is why we are where we are. We're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't. And we just don't know. Until we know more about how this is going to settle out and what the economic implications are for employment, for inflation, I couldn't confidently say that I know what the appropriate path will be.
So following on that, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks. And that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen. but they haven't materialized yet. They really have. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hasn't happened yet. And also there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that, but in the meantime, yes, we're watching it extremely carefully like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we of course tapered and everything. And then we immediately went into QT, and we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential. And we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera?
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that you know we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis. And that's it. And you know, we dropped out of the network for greening the financial system. So we didn't do much on climate. But I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And you know, the risk is if you go for things that are really not on your mandate, you know, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. You know, what we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, you know, wanted to hear it that way, but that's not at all what we meant. So that's just not a correct reading of our, but I can see how, you know, maybe people found that confusing, and you know, we have to take that into consideration.
Jolene. Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses big and small are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, you know, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. And so they're worried now about inflation. They're worried about the you know, a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so you know, we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there will be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. You know, people are not getting laid off at high levels. You know, initial claims for unemployment are not increasing, you know, in any kind of impressive way. So the economy itself is still, you know, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Chris.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, you know, what kind of interest rate decisions you will make later this year. So does that in March, there was guidance that 2 cuts might happen. 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
We don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. We don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we have the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. It could include us holding where we are. We just are going to need to see, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the 2 goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other. And if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension. But if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. I think what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
We don't give Congress fiscal advice. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path. And it's on Congress to figure out how to get us back on a sustainable path. And it's not up to us to give them advice.
Well, do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risks to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or a tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
Yeah, I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less, equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. So, but what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly?
I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decisions. So the volume of the imports, imported goods increased significantly. So the impact of the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to unusually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of the first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories government or inventories government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to. I don't think it's going to affect our decisions. I will just say though that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean look at the state of the economies. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses, and so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting, and so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right that we had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you were monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else. And, right now we see inflation, kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night. And this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not, I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy. When it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
OK， 终于讲完了。OK， 兄弟们啊，终于熬完了这个整个的一个过程啊。那么咱们现在呢，把这个图呢给大家看一下啊。好，那这个呢，今天的这个讲话呢，其实并没有引起太大的这个震荡啊。但是呢，我跟大家大概的总结一下，他刚刚讲的是什么东西啊？然后呢，大家看看有什么问题就在留言区告诉我一下啊。那么基本上今天的内容呢，还是千篇一律啊，跟之前的没有什么大的变化啊。就是他的意思呢，就是现在经济呢还是很好，对吧？经济好，然后CPI 呢还是控制在2%的以内啊，对吧？然后呢，暂时啊，就是说这个关税引发的这个物价上涨啊，通货膨胀可能是暂时的，但是呢，哎，他说话就是真的是滴水不漏啊，我真的是佩服这种老狐狸啊。他说这个希望是暂时的，但是也有可能呢是长久的。这个长久的话，那后面呢就可能会有一些政策吧。 然后他说关税的可能会影响这个就业率下降啊，接下来的时候啊，就业率下降以及通货膨胀的上升啊。那么，所以现在呢，这个来看啊，关税的影响可能要比预期的要大很多啊。但是呢，现在又没有办法去预测，对吧？他说你们这个各种各样的经济学家都去预测，但是呢，这个我们不能拿预测的这个结果呢，或者是数据呢，来决定降不降息，对吧？那我觉得他说的没毛病，对吧？然后呢，他说这个不着急降息，要耐心等待 ，wait and see，wait and see，说了不下于20遍啊，我就是一直在听他说 wait and see， 就是等和看啊，也就是说走着瞧啊，一边走一边看嘛。然后这个接下来有一些问题啊，就说这个关于衰退的问题，关于软着陆的问题啊，等等等等吧。反正他回答的呢，还都是真的是滴水不漏啊。这种如果说你们有做这个什么某个公司的新闻发言人的工作的啊，可以学一下鲍威尔这哥们儿，这老狐狸真的是太厉害了啊。那么好，关税的各种各样的不确定性太多，等等等等，巴拉巴拉，然后 GDP。说着这个2024年到现在 GDP 涨了2.5%，对吧？所以经济依然很强劲啊，对吧？然后呢，关税不能用这个关税来决定降不降息。总之呢就是这样子啊。然后有一个记者问到这个川普啊，川普说这个不解雇你了，然后会对你这个你怎么看这件事情？他说这个川普呢从来不会影响到我的工作啊，就是然后他说这个记者问到这个川普说不解雇你了，你怎么说？他说我对这件事情呢不评论啊，不做出评论。也是非常的这个聪明啊。然后 QE 啊，他说 QE 呢，有个记者问 QE 就是量化宽松拖得太久了，拖得太久了，那个什么时候呢？还是那句话啊，你问什么问题，人家都是说 wait and see，wait and see， 就是等着瞧等等，对吧？然后有一个问题有一个记者问到的非常关键的问题啊，说3月份的这个美联储的议息会议 FOMC 会议上说，今年呢2025年有2次降息，对吧？那现在啊，你对这个还有什么看法呢？他说，现在呢我们不做预测啊，说6周后还有一个 SCP 的会议啊，也就是下个月的时候呢再说。那么刚刚我也是看了一眼这个美债的收益率啊，那有可能6月份都不降息了啊。那他说的这个6月份有可能降息，也有可能保持现在的利率不变啊。他说的是2025年啊，那2025年本来有2次降息的预期的，如果说因为关税的问题或者是因为什么的问题，然后不降息了，我觉得这也是对接下来的这个走势的一个很大的一个利空啊。那么最后有一个女的问啊，就是这个你在这个你之前呢也跟奥巴马总统见过面，跟拜登见过面，川普第一任期的时候也见过面，那现在你怎么不跟他见面了？然后鲍威尔说，我从来呢不主动请求跟总统任何总统见面，那他们找我就去见他们，对吧？这个呢也是美联储的一个作为一个独立的一个机构吧，就是不依附于任何的强权或者是政府啊。我觉得鲍威尔这句话说的非常非常的棒啊。好，那咱们看一下这个评论区啊，大家有什么问题啊？特朗普今天讲话吗？对，官僚说话都是一样子的，就是川普大嘴巴啊，川普是没有读过什么书的啊，川普的文化水平也很低，他能上大学呢，根据他们家人的这个回忆录啊，就是写的书，他能上大学应该就是找人帮他考试呗，就是那种有富家子弟哈，你看他说话的水平就知道了，从来不说什么大词儿，之前我忘了是哪个朋友给我讲的，说，哎，你看其他总统讲话我都听不懂。川普一讲话我就听明白了。我说川普用的词汇大部分就是小学的词汇啊，就美国小学生用的词汇，你当然能听懂了。因为这个咱们从这个中国大陆过来的，只要4、6级过了的话，那基本上就是美国小学毕业的水平吧。然后没有什么大词啊，全部都是短句，连这个定语从句什么这种从句都不用，全部都是短句，然后非常简单的词汇，你当然能听明白了，对吧？所以这个我们从这一方面来看，川普呢是一个特例吧。今年有3次降息啊，刚才没有了啊，刚才已经说了啊，有可能没有了。然后6月份非常确定，6月份是不会降息了啊。川普拉盘，你们评论区能不能统一啊？有人说砸盘，有人说拉盘，我现在看这个没怎么动啊， 96000吗？还是不要一惊一乍的啊，兄弟们。砸盘了。现在今年不降息啊，不是5月份肯定是不降息了啊，然后6月份大概率也是不降息了，对吧？5月7号下午没有安排，根据好4点讲话。ADA 瀑布了，快做空。ADA 怎么才做空啊？我告诉你们，都在0.72的时候我就告诉你们去做空了，对吧？那是几号的时候啊？4月25号，4月25号我就通知你们去做空了。你看这一波跌的啊，还没有到底啊，还没有到底。一个反弹，两个反弹，还得往下砸。大概位置呢，就是在0.6到0.62吧，这个区间。ADA， 刚才我看到有个人说 WLD 是吧？是谁讲的？世界币啊，我们看看世界币最近也是，挺惨的，跌的挺惨的，这一波跌的也挺惨的。但是世界币在美国合规了啊，在美国合规了，这个事情呢，很少有人讲到，因为现在这个山寨币确实没什么行情啊。但是世界币，这一波如果不行的话啊，就是如果说你被套了的话，我不建议卖掉啊，不建议割肉啊。世界币还是有一个很好的未来的。你去看，你去下载它的这个软件啊 ，Word ID Word Wallet， 你去看他们做的事情，你就知道这个项目的野心非常大啊，非常大。放量了，你们看的是什么放量？这个消息呢，要在市场上要发酵一下啊。5月份不降息，其实已经提前兑现了，因为从这个97000啊这一波横盘，其实就是在等待。然后在这个地方的时候，有人就可能就知道啊，5月7号早上的时候，可能有人就知道消息了，对吧？知道消息了，然后就开始跑了。然后还有人这个地方做一个small反弹一个动作，但是接下来还是往下砸。所以啊，等这个市场上这个消息啊，等一下东八区的交易员还没上班呢，对吧？等他们看到这个消息的时候，再往下砸一波。那么有的跌了啊。现在来看，如果没有量化宽松，没有降息的话啊，那今年就差不多就这样吧啊。那么在这里呢，还是提醒一下直播间的朋友们啊，如果说有全职工作的话，千万不要辞职啊！现在经济真的是太烂了。那么美国的经济很烂啊，中国也不好，对吧？然后我不知道其他的地方怎么样。那么这两个地方我是最关心的。现在来看这个比特币，我觉得这一波，回头我再做一个视频吧，跟大家讲一讲啊，这一波应该是反弹差不多了啊。之前我告诉大家反转，但是这个反转啊，就是你怎么去界定反转嘛？其实我当时告诉大家，在这个75000的时候，告诉大家是反转了，其实是这个走势确实是像反转，但是它没有突破，它突破不了前面的高点的话，那就是一个就很难讲啊。而且现在这个宏观真的是太难搞了。那么今天还有一个消息就是，中国派了一个副总理啊，叫何立峰，然后要去瑞士跟美国的贝森特去谈判。那么关于这个谈判呢，我觉得呢，应该也是没有什么好的一个结果吧。因为这个谈判呢，还是在第三方去进行的，所以看不出来呢谁低头，对吧？如果说美国派出代表团直接去北京啊，那说明美国这边低头了。那如果说中国派出代表团来华盛顿来谈，那说明中国低头了。那现在来看，两边都是梗着脖子啊，都不是他妈的好惹的料。所以这个有的搞了啊，接下来这个拉锯战。比谁更烂？是的，哎呀，这个 WLD 扫现货行不行啊 ？WLD 你要等啊，你就算买了，你要打 打算拿上个3到5年，不是短线的，短线看不出来的。WLD 这个很鬼的这个东西啊，他们本身做的是长线的事情啊，你不要用短线的思维来去操作它，短线你可能会熬不住。如果说用长线的思维来看它的话，我觉得前面这高点一定会突破的，假以时日啊。但是还是那句话啊，没有量化宽松，没有 QE 啊，没有这种美联储的放水，它就没有山寨季。所以说山寨啊，还有的跌了啊。这种垃圾的爱达币啊，我不知道你们看不看那个傻逼博主啊？有个傻逼博主天天让你们去买啊，那谁买谁倒霉，对不对？这种破玩意儿，如果说有现货的话，反弹就跑，反弹就跑啊。然后只要短时间内上涨，那我就空它，对吧？那这种币我觉得就是给我们送钱的这种垃圾项目，毫无基本面啊，就是一个诈骗，纯诈骗项目啊。ETH 也是一样子的 ，ETH 非常惨。现在我觉得我都不愿意去看山寨币了，就是这种怎么看这个形态都是一样子的。不过有一个以太坊有个利好是什么呢？就是远古巨鲸跑的差不多了。也就是说再往上拉盘的话，那么什么叫远古巨鲸啊？他们的成本价在0点几啊，0.31。然后你可能是在3000、4000买的，人家是0.3买的，人家现在熬不住了，对吧？熬不住跑了，那又意味着这个再往上拉盘的时候，他们就没有筹码跑了，去砸盘，没有筹码去砸盘了。那对于后面来讲，我觉得长期来看是一个很大的利好，但是短期来看看不出来啊。应该没有什么了吧？大家现在咱们直播间还有496个人啊。那么大家没有关注的点一下关注啊，没有订阅的点一下订阅。然后今天看时间吧，看时间我看能不能做一期总结的视频啊，再跟大家聊一聊。大家有什么问题呢？可以去加我的这个电报群啊。刚才电报群我再发一下吧，电报群的这个链接我置顶一下吧。我置顶一下，没加这个群的去加一下，然后呢，我都会通过让所有人都进群的啊。只要你不是那种广告帖子的话，我都给你进群了。然后我想想还有什么东西，应该没有什么了啊。其实今天鲍威尔的讲话啊，就是这个美联储的那个传声筒叫 Nick， 这哥们儿刚才提问过了啊，Nick 叫什么玩意儿？他今天写了一篇文章，其实就概括了鲍威尔今天的一个讲话的内容啊。So 怎么看 ？Solana 啊 ，Solana，还是一样子的啊。山寨季要看整个的宏观环境啊，没有钱进来，怎么都涨不了，怎么都涨不了。比特币还有一拼啊，还有的拼，因为比特币它毕竟是一个避险的一个资产啊，大家相信的多，对吧？就像这个传销的一样，它是第一个做的，然后呢，它就是占了一个哇，这个比特币这一波跌的挺猛的，砸盘了是吧？我告诉你们，在鲍威尔开始讲话的时候去开空单，有几个人听了？那他是在11点半的时候，11点半啊，11点半正好是最高点，对吧？有几个人在这个地方开空单了？哎呀，远古交易所3422个大饼消息灵通，昨天早上提出来。我是在美国西部啊，狗狗币还是狗狗币都不用看了，狗狗币一样子的，狗狗币也是跟着这个宏观经济的大环境走的啊。现在大环境不好，什么币都涨不起来。你看这个 K 线走势的话，这种确实是看不到希望的，看不到希望，好吧 ？Link 也是一样子的，都一样啊。但是呢，我不建议大家去做空狗狗币，因为狗狗币为什么呢？因为这个马斯克，你不知道他什么时候喊一单就往上窜了啊，你这个空单可能随时就会爆啊。那咱们就是捏柿子呢，就挑软的捏，对吧？像这种垃圾爱达币，也没有名人给他站台， 就靠着他的这个创始人，一个学历造假的一个创始人，对吧？说是什么数学系数学博士，其实他妈的本科都没毕业。这种币啊，创始人有这个污点，然后呢，原始的创始团队拿着钱去嫖娼，然后呢做了他妈的7、8年，智能合约做不出来，然后呢天天还徘徊在这个前10名，对吧？徘徊在前10名的话，然后呢，还什么东西都没有，对吧？链上什么东西都没有，一塌糊涂。这种啊，咱们就捏它，对吧？咱们就做空它，这种安全，好吧？大家能明白我的逻辑吧？好，那我今天啊，现在我这个今天是周3，我们这周3小孩这个放学早啊，那个我要去接孩子去了啊。咱们先到这儿，然后接下来的行情呢，还是看空啊，以看空为主。那比特币现在又往下砸了一波。那么比特币啊，刚刚在直播最开始的时候，我告诉大家了，这一波如果说抄底现货的话啊，看86000啊，86000的这个点，好吧，86000这附近。还是那句话啊，预测呢不准啊，预测呢都是猜，所有人的预测都是猜。但是呢，我前面卖了很多的山寨币，我们这个带着会员群啊，买了一个山寨币，短时间之内是涨了3倍。那我们涨了3倍之后，我们把这个钱呢就拿出来了，现在这个放在理财里面，准备抄底比特币。那么安全的这个抄底的点位就是86000了。好，刚才讲的那个垃圾币就是爱达币啊，看过我视频的朋友都知道啊。好，那我们今天先这样了啊。如果说你还没有点赞的话，给我们这个视频点赞啊，然后呢订阅一波啊，然后如果说你觉得咱们这个频道这种直播的形式有感兴趣的话，还可以看看我之前的录播的视频啊，那也有很大的信息量啊，给大家提供大家，非常感谢大家的陪伴。那么大家点一波赞啊，然后呢订阅一波啊，我们下一次直播再见。然后呢每周呢也会有2到